Market really cares ultimately about revenues and earnings.
The key thing that equities need is strong growth.
If we were to get in a situation where investors are spooked by the bond market, you could easily see pretty good sell-off.
We take up the backup in bond yields as an opportunity.
What history tells us is that periods of exuberance can last for a long time.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now as we come into Wednesday once again at all-time highs on the S&P 500. Equity futures on the S&P adding some weight to the rally, up 0.25%. On the Nasdaq 100, up by 0.6. After a three-day winning streak on the S&P, we add some weight to the S&P 500. Our day ahead setting up as follows. It looks like this. Look out for the data later on this morning. ADP report at 8:15 Eastern Time. ISM services, 10 o'clock. Don't miss that. And then the big one. Lisa, Chairman Powell, 1:40 this afternoon.
How much is he going to really inform us after we've already heard from a series of Fed speakers, including yesterday when we heard from Mary Daly and Adriana Klugler talking about how essentially the path of rates is going to be lower. This is a Federal Reserve that's setting the bar that much lower to cut rates at a time that the economy keeps outperforming, and that is giving that upward boom where the U.S. seems to be the only alternative.
The United States right now looks like a bastion of stability compared to the rest of the world. We've got martial law for a few hours over in South Korea. Still have no idea what that was about. We'll try and figure that out this hour. Then over in Europe, France, facing the real possibility of that government toppling by the end of today's session.
That's right. When you look around the world right now, actually the U.S., even though at this point, potentially leading up to the election, people were talking about we might be in a state of chaos. It actually came and went without a lot of fanfare. But right now, around the world, there is these concerns. And John Authors talks about something, Jonathan, you've talked about for months, which is countries around the world punishing incumbents, whether that's because intractable logjams in places like France or Germany, or for other issues that are going on, this attempt to assert order like in South Korea. The global order is changing and people are looking for new ways, and maybe that means leaning into more populist voices.
That was the shocking aspect to me. Back in 2016, Donald Trump was a disruptor. He was considered the chaos agent, and people were wondering, wow, the bastion of stability of the United States is no longer, and now it's the bastion of stability in a world that seems to be one after another falling like dominoes. We're going to look back at this moment as some sort of pivot point. I don't know to what, but it is fascinating to me to see such political turmoil in G20 countries that are traditional allies of the U.S. that are facing internecine pressures that rhyme, and I'm trying to get my head around exactly how.
In the equity market at the moment, nothing to see here. All-time highs on the S&P 500. Equity futures a little bit higher again this morning. In Europe, plenty to talk about, and we'll do that through the hour. Euro-dollar just about holding on to 105. Coming up this hour, we'll catch up with Laurie Heinel of State Street with stocks of fresh all-time highs. Sebastian Raedler of Bank of America ahead of a no-confidence vote in France. And Al-Hussainy of Columbia Threadneedle on the fallout in South Korea. We begin this hour with stocks rising after posting their 55th record high of the year so far. Traders looking ahead to remarks from Fed Chair Jay Powell a little bit later on today. The team over at State Street writing the following. We expect the narrative of rate cuts and resilience to hold in 2025 and for our projected soft landing to materialise. This landscape extends our favourable outlook for equity markets. Laurie Heinel of State Street joins us now for more. Laurie, welcome to the programme. Do you not think that the policy changes that we could see in the next 12 months would be potent enough to disrupt the kind of resilience that you're looking for?
Well, it's too early to tell. I mean, obviously, there are a number of cross currents in what the Trump administration is proposing that could be a threat to what we've seen as a soft landing so far. But until we actually have the ink dried on some of those policies, it's hard to know how those crosswinds will actually impact the real economy.
The political changes elsewhere have been a threat to markets elsewhere, that's for sure. Check out the euro, holding on to 105 briefly, looking at 104 again this morning. Over in South Korea, we've seen the disruption there as well. Laurie, is there scope for some performance ex-US at a time when a lot of people are on this programme saying, buy one thing, buy America?
Yeah, well, right now we still are on the momentum bandwagon also. I mean, what worked well in 2024 is likely to persist in 2025. And that suggests that US large cap in particular has room to run here. But what we've also been talking about is a broadening out. So it's not just about the high flying Mag 7 tech names. It's about financials. It's about, potentially energy. It's about other places like consumer discretionary that may benefit from an upgrading of the US economic prospects. So it's a little bit of a nuanced story, but yes, sadly or not so sadly, we're still buy American large cap as our primary call.
I can't find one person who's not, Lori. And this to me is really a key question. How do you hedge against the idea that at some point the momentum does run out?
Yeah, well, I think there are a couple of things that we're doing. I mean, first and foremost is we are trying to avoid those higher, high flying names and looking at quality or companies that can be a bit more durable through this kind of cycle. The other thing is broadening out a little bit, looking at small cap US, for example, which might have a little bit less vulnerability to some of these global crosswinds. And to look for diversifiers. So we have had a position in gold in our portfolio because, as you've seen over the last couple of years, stocks and bonds are often moving in lockstep. So getting some diversification into the portfolio so that you have something that's going to zig when the rest of the world zags is very important for us as well.
This is important. Are you basically saying that 60-40 and the concept behind it has been upended? That essentially we are looking at bonds that no longer are the diversifier. You're looking at moving out into other types of companies and gold. You didn't mention bonds once within that. So at a certain point, does this have to fundamentally upend the way people construct their portfolios?
Well, not necessarily. And in fact, I think in some ways we're in a better position than we were a few years ago when interest rates were zero. So at that point in time, we were very much in the camp that bonds just weren't providing the kinds of benefits that investors typically needed to enjoy from them. But we do now have some income in bonds. So despite the fact that equities have powered forward, S&P up 25% or so on a year-to-date basis, with fixed income kind of earning a coupon, it's still earning a coupon. So it's really more about a nuanced positioning. So definitely still retain that allocation of bonds. We think that they're going to return at least coupon, perhaps plus, but looking for other things, especially if we have some, drawdown risk in the equity markets.
Well, when you look at potential drawdown risks in the equity market next year, is it policy coming from Washington? I know you're bullish in the fact that potentially we're going to have these tax cuts, looking at your research, but how do you look at tax cuts potentially next to the walls going up and higher tariffs?
Yeah. I mean, this is the thing. There are crosswinds even within the stated policy objectives, right? So if you think about immigration, potentially it takes labor away from sectors that are already a little bit vulnerable. Think housing. If you look at tariffs, obviously that creates vulnerability around the inflation front. We do think that the Fed is going to cut here in December, but we think that next year's cuts are a bit in jeopardy as we wait for this agenda to kind of play through. So that's what's really tricky for investors right now, is it's hard to know precisely where the dust settles.
If investors wanted a base case for next year and how potential Trump policies might impact the Fed, would you say there's this idea of pauses for 2025 or even potentially a hike?
Yeah, so we had originally penciled in 4 rate cuts in 2025, and we're now really lowering that, looking at maybe 2, probably a pause around the beginning of the year, in part to see how these policies do shape up. And by the way, the Fed, if they do cut this month, and especially if they cut for 25 basis points, they'll have cut 100 basis points. So while we think that there's more to be done and we'd like to see them do more, we think that it's likely that a pause in early 2025 is warranted.
Laurie, all the Fed speak over the last few days just giving us the impression that they believe, these Fed officials believe, there's a long way to neutral. I was going through some of what Fed Mary Daly had to say, what the Chicago Fed President Goolsbee had to say, Governor Waller more recently as well. Where are you on that? Just how far away are we from what they consider neutral to be?
Oh, we agree there is a long way to go for neutral, but the problem is that we could have some inflationary pressures budding in the early part of 2025. And so one of the things that they also have to be very mindful of is that they don't cut so aggressively that they're in a position of having to hike more rapidly than they would have liked. So we've always said that this inflation trajectory was not going to be a sort of smooth, one-way direction. There was likely to be a little bit of bumps along the way. So it's more a question of timing. But we do think that neutral is quite a bit lower from here.
Chairman Powell speaking at 1:40 later on this afternoon. Laurie, appreciate your time. Enjoyed the outlook. Thank you. Laurie Heinel there of State Street. New outlook drops from Steve Englander over at Standard Chartered. This is what he's got to say. We started the programme this way, talking about the relative stability in America compared to the rest of the world right now. US exceptionalism is a problem for the unexceptional. Our baseline view is that the dollar will strengthen in 2025, but will face an air pocket of weakness early in the year on continued Fed rate cuts and uncertainty over policy implementation. On that last point, and I think this is really important, and we'll spend some time on that a little bit later this morning, the incoming Senate Majority Leader really laying out where the emphasis will be when they hit the ground running in 2025, and the tax cuts might have to wait.
Tax cuts might have to wait. The issue, of course, they're going to have is we need to get through this year in terms of spending. So they might have to kick the can down the road till March of next year. And then they need to start thinking about another spending package, which could include the tax cuts. The sequencing is going to be very important, which is why a lot of people are nervous, because when you look at how you can get things done, tax cuts, you need Congress. Tariffs, if these are two of your big policy proposals, tariffs Donald Trump can do on day one.
You said a lot of people are nervous. A lot of people in political circles, not so much in markets. And I think that disconnect is what's fascinating. At what point does some of the policy nervousness in political circles percolate over into what you're seeing in the markets that right now are seeing glass half full and just this fabulous American exceptionalism continuing forever?
All-time highs this morning once again. Equity futures on the S&P pushing higher by a few tenths of 1%. With an update on stories elsewhere this morning, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. South Korean lawmakers submitted a bill to impeach President Yoon after he declared martial law yesterday and then reversed it hours later. The surprise declaration caused a standoff with Parliament. Lawmakers rejected Yoon's attempt to ban political activity and censor the media, while armed troop forces made their way into the National Assembly building in Seoul. The country's defense minister has already submitted an offer to resign. Shares of Salesforce surging by 13.5% pre-market. The top seller of customer relations management software reported quarterly revenue that topped estimates. It underscores Salesforce's much-hyped AI product strategy, which is starting to begin to lift financial results. Intel's search for a new CEO will focus heavily on outsiders. According to people familiar, the chipmaker is considering candidates like the head of Marvell Technology and former Cadence Design Systems CEO. This week's sudden ouster of CEO Pat Gelsinger set off an urgent search for new leadership, with its bench already depleted by years of management turnover. That's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, the French government heading towards collapse.
The conditions that brought us here, which is really the French budget, will not be resolved then for another year at least. And that, of course, is not good for French finances. In the current circumstances, we just continue as is, the budget continues as is, but that means that the French government will not be able to consolidate.
The latest from Paris, France, just around the corner. Live from New York City this morning. Good morning. We have a new biggest bull on the street. Welcome Chris Harvey of Wells Fargo. The target 7007. He says it's for the James Bond aficionados. I imagine more work went into it than that. This is the quote. We expect the Trump administration to usher in a macro environment that is increasingly favourable for stocks at a time when the Fed will be slowly reducing interest rates. In short, leads to a backdrop where equities continue to rally.
And he's not alone. It's just a matter of the scope. Who can get higher at a certain point when you can imagine the American exceptionalism story having legs? I just wonder whether people are pricing imperfection. And I want to just talk about the rate cutting path. We're seeing Citigroup's U.S. Economic Surprise Index tick higher once again to the highest levels that we've seen going back to the beginning of this year. At what point do people start questioning just how much inflationary momentum there actually is in this economy?
Chairman Powell will need to address that a little bit later on this afternoon. Look for that, 1:40 Eastern time. Equities right now pushing higher by 1/3% on the S&P. The euro just about holding on to 105 against the US dollar. Euro dollar 105.01. Under surveillance this morning, the French government heading towards collapse.
The conditions that brought us here, which is really the French budget, will not be resolved then for another year at least. And that, of course, is not good for French finances. In the current circumstances, we just continue as is, the budget continues as is, but that means that the French government will not be able to consolidate. European Commission will be watching France very, very carefully and will demand that down the line, France makes the decisions that it needs to do, the necessary cuts. So all we will get is a postponement of very hard decisions that need to happen.
So here's the latest this morning. Investors bracing for a no-confidence vote in France's parliament in a matter of hours. The political turmoil creating more uncertainty about Europe's future. Joining us now is Bloomberg's Caroline Conan from Paris, France for more. Caroline, welcome to the programme. What's the latest and what does the next 24 hours look like?
We're less than 4 hours away from the beginning of the debate of this motion of no confidence right behind me at the National Assembly in central Paris. And clearly the chances of the Prime Minister Michel Barnier's government to survive today are very low. He had some hope. He said last night on the 8 o'clock news that there will be some kind of reflex of responsibility from MPs. But clearly the National Rally of Marine Le Pen has already said that they will support this vote of no confidence, even though it has been proposed by the far left. That would be something of unbearable cynicism. These are the words of President Emmanuel Macron, who still in Saudi Arabia is going to come back from the state trip later today. Emmanuel Macron, who then obviously will have to name a new prime minister. Some say that this could actually happen very quickly in the next 24 hours to avoid this uncertainty that we are seeing in the markets, that we are seeing on the budget path for France. So a lot will happen in the next few hours, but the big chance is that we're going to see a new government in the next 24 hours.
Caroline, appreciate your reporting. I've enjoyed it all morning. Thanks for being with us. Caroline Conan there from Paris, France on the latest. Things in markets, Lisa, just quietened down just a little bit over the last few days. Things have settled down.
Yeah, there seems to be at least a little bit of a give and take and a question mark of exactly what happens even if the vote of no confidence goes through. I do have to wonder, though, from a structural perspective, what this means, especially at a time where, sure, yields are coming in France. Check out the yields in the periphery. They are going way down. People are saying this is the area of stability that I want to be in.
So in the United States, it's difficult right now to find an investor that wants to buy in Europe. So we found one in Europe for you. Sebastian Raedler of Bank of America seeing upside for stocks on the continent, writing the projected upside for relative Eurozone growth momentum implies tactical upside for European versus global equity. Sebastian joins us now for more. Sebastian, welcome to the programme. We've been talking about this for the last few weeks on this programme, how little needs to go right to really start to trigger a move higher in European equity. Sebastian, do you think that might have already started?
Well, I would distinguish, and you saw the quote from our research just now, between the absolute call on Europe and the relative call. And they're just worlds apart. So in absolute terms, European equities are within 3% of the all-time high. Domestic growth momentum is weak, and everybody is here scratching their head saying, why do you still have an equity market that effectively is at peak levels? And the answer is effectively US exceptionalism. The US economy has powered the global growth story ahead. Global risk premia are extremely tight, and it has put a floor and the European asset price. But in relative terms, you've seen tremendous underperformance. You've underperformed by 15% on the basis of this relative growth weakness. And so that on a relative basis, we see scope for European equities to outperform because you have now priced an idiosyncratic risk premium that is not in the rest of the world. And if we see a little bit of an improvement in growth momentum, that could start to be priced out.
Sebastian, you've seen this move in Germany specifically. The DAX at all-time highs. We've seen record after record in Germany. Year to date, the likes of Commerzbank up by close to 40%, Deutsche Bank up by 36%. Is it the financials, the banks of Europe, where you are thinking that might be where the outperformance comes from?
Again, I have to spin the story from the other direction. Banks have already outperformed tremendously. Insurance has. Financials generally have done very well in an environment in which risk premia. So look at the US high-yield credit spread, the best gauge for global risk premia. It's basically in the bottom 1% of the historical distribution. Banks, financials more generally, have benefited from tight risk premia and high bond yields. So this is one area where you have not priced any negativity, any kind of risk premium. So I'd be very cautious on the financials, which are already priced relative is at a 5-year high. What I think is more interesting are those elements where a lot of risk has been priced, either the China plays in Europe, semis and luxury, and it's also the broad European equity market relative to global equities, because that's where the underperformance has been. It has not been in financials.
Sebastian, you said a comment that I want to pick up on. You said that one thing that people have underestimated is that the strength of the U.S. economy is powering the global economy, including in Europe, and that's one of the reasons why you are seeing ongoing performance, good performance in certain places. How long can that continue, given that we're talking about the U.S. potentially putting barriers up and trying to insulate some of its business and some of the strength?
Absolutely. I was listening to you earlier on the program and found myself nodding to your comments, because I think the two of us seem to be sharing a skepticism. Everybody seems to have accepted that this exceptionally strong run in the U.S. Is now freed from the shackles of the cycle, that it will continue indefinitely. And I sense basically a skepticism there on your part, and I would definitely share it. We see a lot of scope for the US, which single-handedly has been powering ahead the global economy, to slow into the first half of next year. There's going to be the impact of the strong dollar. What you have in Europe versus the US, which is fascinating, a completely desynchronized inventory cycle. The inventory cycle is giving the strongest support to the US economy in 10 years. In the euro area at the moment, it's a meaningful drag, but these are short-term swings and they're going to reverse into the first quarter. We also see a lot of scope for disposable income growth for the consumer to slow, as for instance a crackdown on immigration weakens employment growth in the US. So take it all together, we see scope for euro area growth momentum to surprise to the upside, US growth momentum to surprise to the downside. On a relative basis, that's of course good for European equities, but overall that means weaker global growth momentum. It means wider risk premium from very low levels, and that's bad news for asset prices across the board.
Does it concern you, Sebastian, that the two largest economies in the euro region are facing a governmental collapse?
Well, I would say France is a downside risk, but in a funny way, Germany is an upside risk, because you have run extremely tight fiscal policy in Germany for 20 years, arguably too tight. You've underinvested in your public infrastructure, and it's really starting to show. Potentially, if you get the outcome that we expect for the German election in February, you will get the CDU, center-right, in charge. They used to be fiscal hawks, but now want to do fiscal easing. So potentially more fiscal stimulus out of Germany is on the way, and we really haven't seen that in a long time.
So potentially, does that mean now is the time to go into some of the manufacturers, some of the autos that have really had a bruising time the past few months in Germany?
I think the autos are very tempting. I see my autos analyst on the floor every day, and he's chuckling. He says, when do we start to buy? The problem with the autos is it a cyclical story or is it a structural story? You get a lot of onslaught on competition from your Chinese competitors. You really have snoozed through the technological revolution in the sector. And so therefore I would say there are a number of cyclicals that are very beaten up in Europe. As I already said, semis look attractive because they have very high competitive modes, and they will not be disrupted anytime soon. Luxury seems to be discounting too much macro weakness, but for the autos, there's a real case that your business model might be structurally flawed now. So I'd be more cautious on the outlook for autos, even though clearly they have sold off a lot.
When we take a step back, though, we look at how potentially Europe is going to deal with the Trump administration next year. If the two largest economies have political chaos right now internally, how are they going to act as one voice when potentially we're going to see a U.S. president put up the walls and tariff barriers?
Absolutely. It's a huge challenge politically, cyclically, but also structurally, because you have to reinvent effectively the German business model. But I'm always asking, what is in the price? You currently have an 8-point gap between the euro area and the US PMI that's close to record levels. Part of that is due to the inventory cycle. We've already discussed that will reverse. Credit conditions in the euro area have improved dramatically. The fiscal angle out of Germany could be more positive. And you've got, on a relative basis, European versus US equities pricing a further deterioration in relative growth momentum. So clearly, Lisa, there are risks, there are political risks, but a lot of negativity is priced, and a lot of the underlying growth drivers look more favorable than the current market pricing would suggest.
We promised to find a European bull, and we found one. Sebastian, appreciate your time. Thank you, sir. Sebastian Raedler of Bank of America. A lot of pessimism in the price. Speaking of the autos, so far, year to date, Stellantis is down by more than 40%. Volkswagen is down by close to 30%. Mercedes is down by about 15%. terrible year.
Terrible year. And for somebody who's looking for relative performance, they think, wow, these are really cheap. You know, that's the reason why Sebastian was saying every time he goes near the auto analyst, you know, he's like, all right, can I get excited? The answer is not necessarily. And that's the question. Can they get the technological advance needed to really get an upper hand?
Well, we have some headlines as well from the VW CEO in the last hour talking about telling workers that the current union proposals to cut costs insufficient to address what's going on. There's going to be a lot of cost cutting.
They've got some big issues, that's for sure. Coming up on the programme, Al-Hussainy of Columbia Threadneedle following a day of political turmoil in South Korea. A conversation on the other side. From New York, this is Bloomberg. Three-day winning streak on the S&P 500, another record high. Your scores look like this. Equity futures on the S&P this morning, adding some weight to the rally. Up another 0.25% on the S&P 500. On the Nasdaq 100, up by 0.6%. If you get to the bond market, the focus will shift throughout the morning to the economic data. 8:15 for an ADP report later on this morning. ISM services later on this afternoon. You'll hear from Chairman Powell. Bond yields at the moment higher by 3 basis points. The 10-year 4.25.17 on a 2-year yield higher by about a basis point at 4.18.76. Let's finish on Europe and go to the euro. We can take a look at what's happening in the FX market. The euro just had its worst month of the year so far against the US dollar. Euro dollar at the moment at about 1.05. That's the story in financial markets. Here are our top stories. Under surveillance this morning, French lawmakers preparing for a no-confidence vote later on today that would topple the government. Marine Le Pen's National Rally and left-wing coalition have vowed to support the motion, which will pass if backed by both groups. That's the focus for the Europeans this morning.
Yeah, at a time when you have to wonder why markets are rallying around this. Essentially, people see that it isn't as bad as it could potentially be, maybe, because there is this question of whether Macron will just renominate his prime minister. Look, all of this comes down to how do you get confidence in the euro region where the two largest economies, Germany and now France, are facing dissolution of their governments.
And this is basically going to be a bit of uncharted territory because we can't have an election until the summer, because 12 months from last July. So it's going to be just this complete political gridlock in France at the same time that we have political instability in Germany, the two core economies of Europe. And this comes at a time where there's going to be a lot of pressure on Macron himself. Marine Le Pen is really starting to build up a lot of momentum. And while he has a mandate to 2027, is he going to feel that pressure potentially step aside?
They're distracted big time at the moment at a time where it's incredibly unhelpful. Next week, there will be an ECB interest rate decision. We've said this repeatedly on this programme. The ECB is focused on 25 or 50. The Federal Reserve is looking at skip or 25. They're two very different ways of looking at the world at the moment.
Well, and there's a real question here of how far divergence can go. And that, I think, is really the ultimate question. Can you see an ECB that materially cuts rates that leads to a euro that really weakens dramatically at a time when they could be importing that inflation? And this is one of the challenges that they're facing right now.
Here's a challenge at the moment. It's to General Motors. They're taking a $5 billion hit to restructure the troubled business over in China. That headline just dropping. Taking a $5 billion hit to restructure its troubled business over in China. That stock is down by about 1% in the pre-market. This has been a struggle for a while, Lisa. You go back to 2017, 2018, things were pretty good. This is where people wanted to be. They positioned there deliberately. And now this is a place where you're really going to struggle because the competition there is so tough.
When you talk about 2017, it's a great year to kind of benchmark this joint venture to. In 2017, General Motors posted a $2 billion profit on this joint venture. The company lost $347 million in China during the first 9 months of this year. We've seen direct foreign investment fall off a cliff in China, and there's a real question about whether U.S. auto manufacturers can be profitable at a time that China is absolutely having national champions and funneling cash to make sure that they remain so.
GM is just the latest. We've seen this from a number of European, Japanese, Korean autos in China. The subsidies China gives out to their local car industry, to trying to build up these national champions. This is why so many of these companies are just struggling to build and become profitable in China.
But there's a real larger question here, which is, as you hear about a decoupling between the U.S. and China, can U.S. companies remain in China? And there's a real question about what will remain of GM. This is about restructuring a venture, the joint venture that will see GM close plants and cut unprofitable vehicle models. What remains? What going forward is going to be their expansion mechanism at a time where so many U.S. companies thought of China as their expansion territory? How much does some of the recent political noise really upend that?
It's worth noting, a bit earlier in the programme, we were talking about the performance of Stellantis year to date. The stock is down by 40%. Year to date, General Motors is up by close to 50%. They've had a very different year so far. Certainly not because of what's been taking place over in China. It's the strength here in the United States.
Well, although if you spin that forward, they haven't been banking on expansion in China. They've actually been shrinking their presence in China. They have been focusing on the United States. They've been ahead of that trend, and they have been shifting away a little bit more, at least tempering their expectations for adoption of electric vehicles. A really interesting move, and I wonder how prescient it is for other auto manufacturers.
That's the latest on General Motors. That stock is now down, lower in early trading by more than 2%. General Motors seeing a more than $5 billion in charges tied to its business over in China. Elsewhere, investors digesting a host of Fed speak ahead of Chairman Powell's remarks at 1:40 Eastern Time. Mary Daly saying a rate cut this month isn't certain, but remains on the table. Kugler and Goolsby also stopping short of giving a clear signal over the Fed's next meeting, but I think they've all given a clear signal about the direction of travel. They believe there is a long distance to neutral and there's more work to do.
And there's a fragile tipping point for workers who are dealing with a slowing economy at a time where rates are structurally a lot higher. The bar is changing. And I think this is really important to note. The bar is changing for rate cuts. It's not stimulative necessarily. It is about just simply shifting generally to allow this economy to normalize in a controlled way.
Chairman Powell speaking at 1:40 this afternoon, 1:40 Eastern Time. Let's shift to South Korea. Efforts to remove the country's president are escalating after he abruptly imposed martial law, plunging the nation into its biggest political crisis in decades. Members of the opposition ruling party filing a motion to impeach President Yoon, with the country's defence minister submitting an offer to resign. Bloomberg's Jill DeSis joins us now from Hong Kong. Jill, welcome to the programme. We're still waiting for a good answer to this. Why this happened? Why did this happen?
Yeah, it's been a really, really wild 24 hours in South Korea. So the first thing I think to keep in mind here is that it's not like everything was going incredibly well for the president, President Yoon. He had been facing, dealing with quite a lot of tension with this opposition party. The opposition party has the majority in parliament, so they've been kind of stonewalling his budget proposals. They've actually tried to impeach some members of his cabinet. And so there's, some of that tension that already exists in this relationship. But wow, it really felt like it went from 0 to 100 overnight when you've got him coming out, imposing martial law pretty much in the middle of the night. And then I think what you've really seen here is this really, really strong reaction. So you have to remember there's some historical context in South Korea that's really important here. I mean, this is a country that hasn't seen a sort of a martial law order like this in 40 years since a very violent military coup happened. So the public backlash was incredibly swift. People protesting in the streets. And then you also had the opposition party, which, remember, holds a majority in parliament, come out, immediately gather and really shut this kind of thing down. He rescinded that martial law order. And yes, now it looks like, you've got some very serious allegations involving treason facing him. And he now faces a potential impeachment vote.
Jill, what's the reaction been elsewhere? What have we heard from allies, including the United States? And what have we heard from enemies like North Korea? Have they responded to this?
So when it comes to some allies, I mean, you did have, Blinken say earlier that, he's obviously watching the situation here. North Korea, I think, has been interesting just because they've been, incredibly silent. There was actually their national broadcast just a couple of hours ago didn't mention the Yoon story whatsoever. You have to kind of imagine, though, that for, North Korea, which does have an antagonistic relationship, obviously, with the current administration, it might just be better to kind of stay out of this one. I will say, though, that in the event that President Yoon is impeached successfully, if the opposition party leader comes in and actually becomes president of South Korea, that's a party that does have somewhat of a friendlier view toward North Korea. So there could be some pretty significant geopolitical implications at play if this does actually come through.
Interesting. Jill, I know you've been up all night following this story, so we appreciate you taking some time to catch up with us this morning. Thank you. Jill DeSis there, joining us from Hong Kong this morning. Ed Al-Hussainy there of Columbia Threadneedle joins us now for more. He's in New York. Ed, good morning to you.
Good morning.
Instability in South Korea, political instability in France, a little bit in Germany. We've seen it in the UK as well over the last year. In America, there were some people who thought that we'd be sat here right now, December 4th, worried about seeing an outcome of an election and maybe having to wait a few more weeks. What's gone wrong elsewhere?
I think what's striking is what's going on in the U.S. is so isolated from the rest of the world. And especially if you're looking at this through the lens of a market participant or an investor, we have significant buffers versus all this instability elsewhere, and we can really focus inwards, and that's what's been happening.
Everyone else is focused inwards, and they shouldn't be, including France, including South Korea. The problems abroad, is there any thread that you can join, any dots that can join up abroad right now?
Yeah, I think, and we'll have to bring Francis Fukuyama in here for real analysis. But from my perspective, if you look at these developed market democracies over the course of the past several decades, their ability to deliver prosperity has been progressively declining. And that's been a problem. I think we've gotten really good at absorbing economic shocks. Look at how much spillover there's been from Korea elsewhere in the world. But we're not great at delivering that economic prosperity. And that's, I think, one of the common sort of through lines across these developed markets.
Is some of the turmoil that we're seeing now the beginning of a rebuild? We were just speaking with Sebastian Raedler of Bank of America saying, well, we've kind of seen the bottoming out in certain European areas and that possibly the surprise could be to the upside. Do you see it like that, or do you think that people are still underestimating the isolation of the U.S. exceptionalism?
Gosh, I think the U.S. economy still has significant advantages versus the rest of the world. We've spent the last several years pricing those in, especially if you look at it through the lens of the U.S. dollar, for example. Well, the dollar has been rallying since 2011. It's been progressively strengthening. It's been a structural trend. It's really difficult to break that trend, I think, in the coming several years. But in the short term, look, expectations for growth in Europe, expectations for growth in Asia, China in particular, are rock bottom right now. And so if you think about 2025, our ability to surprise those low expectations to the upside should be relatively easy.
The problem is when you take a look at flows, they're just a hoard of cash coming into the U.S. As Mohamed El-Erian said, it's that sucking sound you hear is all the cash just being hoarded up by U.S. assets. How much can you move against that momentum and try to invest elsewhere?
Yeah, it's true. I mean, the technicals here have been fantastic in the sense that the supply of these financial assets, whether it's credit or equity, is significantly lower than the demand. And there's a lot of savings globally coming into the U.S. to finance those assets. I don't think that's going to change. You can see that through the lens of our current account deficit. We run a significant deficit, which means the rest of the world is willing to fund us. That includes the U.S. government. And that's a fantastic position for us to be in. That's not likely to change anytime soon.
Trump has a very bilateral approach when he looks at the world, deals with the United States and one other country. Biden took a very multilateral approach. When you're thinking about U.S. exceptionalism next year, is that bilateral approach potentially going to exaggerate this momentum we're seeing?
You know, my rough sense is both approaches haven't meaningfully changed the structure of the U.S. economy. We're predominantly services-focused, 80% services. We're very closed relative to the rest of the world. You know, trade to GDP here is in the 20s. It's over 100% in Germany. And so these trade-focused changes, policy changes, have de minimis impact on the structure of the U.S. economy and therefore de minimis impact on financial assets.
But the retaliatory effects, potentially, what could that mean for the U.S. economy, like Trump 1.0 and what that meant for the agricultural industry in the United States?
Absolutely. So it comes down to scale. If we impose tariffs across the board, which is a possibility, it's been floated. If there's retaliation, and if that starts us down sort of an escalatory ladder, then you end up in a really bad place. Absolutely, that's going to impact earnings. That's going to impact exporters. That's going to impact jobs. And we'll start to see a policy response from folks like the Fed. How likely is it? I don't know.
Speaking of the Fed, Chairman Powell later. What are you looking for from him? And what do you make of the commentary we've heard so far over the last few days, with official after official, conveying, I think, to the public that they believe there's a long way to neutral? Do you share that view?
I think they're right. I think the strategy of approaching that fact is starting to change. In August, what they told us was the labor market is getting to a pretty good place. Inflation is close to target, but monetary policy is too tight. We're going to realign monetary policy to the data. And that starts us off with cuts. That starts us on a journey to neutral. In the last month or so, the focus has changed, and the focus has been, well, growth is really surprising us to the upside. Inflation is potentially starting to stall out. That progress towards 2% has been declining. And so perhaps it starts to make sense to work in these pauses. That's a big shift in terms of strategy. And so I'm looking for clues as to whether that August strategy is still in play or whether we're changing to something a little bit different.
That's really well framed. And I think a lot of people agree with you. Ed, it's good to see you. Thank you, sir. Ed Al-Hussainy there of Columbia Threadneedle on the political instability abroad and what we're seeing at home in the United States. Equity futures at the moment doing OK on the S&P 500. GM is down in the pre-market. We'll get you up to speed on that and a whole lot more with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. So on that GM story, it's going to be taking on more than $5 billion in charges, falling 1 1/3% in write-downs tied to its troubled operations in China. The automaker is attempting to save its once profitable business in the world's largest car market. According to a filing this morning, just moments ago, GM expects to write down the value of its JV operations in China by as much as $2.9 billion. It will also take another $2.7 billion in charges for costs to close factories and restructure its operations in the country. Meanwhile, shares of Dollar Tree, those are surging in the pre-market, up 3.8%. The discount retailer reported third quarter earnings that beat analyst estimates. It also announced that its CFO will be stepping down. The Wall Street Journal reporting that President-elect Donald Trump is considering Florida Governor Ron DeSantis as a possible replacement to Pete Hegseth to run the Pentagon. People close to the matter say that Trump allies increasingly think that Hegseth will not survive further scrutiny about his personal life. DeSantis was on an earlier list of potential defense secretary candidates that the transition officials presented to Trump. And that's your brief, John.
Danny, thank you. That's a lot of talent in Florida that they need to try and replace.
I think you need to look at this one potentially as not the first chess move, but the second. As Governor DeSantis becomes defense secretary, potentially that's the win he wants to appoint Trump's daughter-in-law to Marco Rubio's Senate seat because he's going to be Secretary of State.
OK, then who gets to be governor? We figured that out yet?
No, but at that point, Trump gets what he wants. DeSantis gets something that he wants for the win to give Laura Trump the seat. What's interesting here, though, is the chief of staff, Susie Wiles, and Governor DeSantis.
Florida.
They have a rough relationship. First, she ran his campaign. They were buddies. But then it ended up being a lot of bad blood between those two.
We'll pick up on that story a little bit later. Up next on the programme, betting on the AI revolution.
Everything seems to be going the way you want it to go. But I think there are significant amount of uncertainties. The market is increasingly paying attention, and the scrutiny is on AI monetization.
That conversation up next, live from New York City. This is Bloomberg. All-time highs in the equity market on the S&P 500 at the moment. We add another 1/4% to the S&P, and the bond market yields drifting higher going into Chairman Powell and a lot of economic data through the week. We're up by 2 or 3 basis points. The 10-year 4.2497. Under surveillance this morning, betting on the AI revolution.
Everything seems to be going the way you want it to go. But I think there are significant amount of uncertainties. The first is AI related. The market is increasingly paying attention, and the scrutiny is on AI monetization. Increasingly, the focus will be on all this money spent, all this hype, where are the tangible results?
So here's the latest this morning. The S&P 500 hitting 55 all-time highs this year, fueled in part by massive AI momentum. BlackRock releasing their 2025 Global Outlook, writing, "We stay risk-on as we look for transformation beneficiaries and go further overweight US stocks as the AI theme broadens out." Wei Li of BlackRock is with us here in New York. Wei, it's good to see you, as always.
Thanks for having me.
AI beneficiaries. At the moment, it's been the big AI enabler. The likes of NVIDIA, which has been the big winner. How does that story change? What's the next phase of this trend?
We continue to like the big tech part of the AI beneficiary. So far this year, they've been carrying the weight in terms of earnings growth. Looking at 12 months trailing, Magnificent Seven grew their earnings by 45% year-on-year basis, versus the rest of the market actually growing only 4%. So there's a significant difference. Continue to be very, very concentrated. But over time, we do expect the beneficiaries to broaden out. We're looking at energy, we're looking at utility, we're looking at industrials as we build and finance the transformation, right? So certainly we have to look at the combination of public and private market as the theme plays out. We continue to think that this is an environment of transformation rather than an environment of your typical cycle. So given all these mega forces, not just AI, but also low carbon transition, geopolitical fragmentation, we're learning real time what the longer term trend is heading towards instead of the fluctuations around a typical stable longer term trend. And that has significant implications on investing over the long term. What is neutral in this environment, right?
Wei, you can't talk specifically about this deal that BlackRock announced yesterday about buying this credit fund manager, but you talked about the convergence of public and private markets. How much are you increasing your allocation to private markets as part of the sort of extra uber overweight of this broader theme?
Well, private market has been growing significantly in recent years, and looking ahead, private market is expected to double in AUM by the end of the decade from the 2023 level. And within that, actually, infrastructure and private credit are likely going to play a big role, both as we think about building the transformation and also as we think about financing the transformation. And so far, if you look at allocation to private markets for a lot of investors, they are quite heavily in real estate, in private equities. So private credit and infrastructure are really exposures that we do think will grow both in terms of the asset base, but also in terms of their allocation in investor portfolios.
That's where I wanted to go, this question of what it means to be even more bullish on U.S. equities and the story of AI. Where are you focusing in getting more bullish? And have you ever been more bullish on some of these names?
Well, right now, as you know, we have been bullish on U.S. equities for all of this year. So we're dialing up risk-taking even more because we do believe that earnings can broaden out, right? We talked about this year being still quite concentrated in terms of big tech doing the heavy lifting. Next year, big tech, Magnificent Seven, expected to grow their earnings by 18% versus the rest of the market, high single digit. You do see the gap closing, and that broadening out is one reason that we believe there is more momentum for U.S. equities to run higher. Another reason is that people look at how expensive U.S. equities are, how concentrated U.S. equities are. Our study shows that if there are good reasons, mega forces, structural forces that could potentially change the longer term trend, the mean revert doesn't quite apply. Mean revert to what if the destination and the makeup of the destination is changing, which is why we're not over-indexing on the current valuation level, especially as we look at investing over the tactical horizon of 2025, and the near-term tax cuts and deregulation talks can drive sentiment further, which is why we're leaning into it.
When you look at your global outlook, you talk about the focus on the United States and what you're seeing in terms of security priorities, national economic priorities at the expense of others. Who is the U.S. winning at the expense of when you look at it the biggest?
Well, when we look at 2025, U.S. exceptionalism is a theme that we expect to play out for the entirety of this year. Within equities, that means that we prefer U.S. equities versus the rest of the world. We use a UK equity downgrade to fund our U.S. equity upgrade. So there is a bit of a kind of leaning back into U.S. equities, but within duration, within government bonds, because U.S. exceptionalism also is associated with greater fiscal spend, we actually prefer international duration like UK gilts market over U.S. Government bond, U.S. duration, where we expect term premium to come back even more, reflecting the higher fiscal trajectory. We also continue to like quality income within a credit, even though spread is very, very tight. From a total yield perspective, it's reasonable, and the tighter spread really reflect the fact that the governments have become more indebted and private sector has been actually managing their leverage somewhat more reasonably.
Wei, it's good to see you. Thanks for joining us here in New York City. Thank you. Thank you very much. Wei Li there of BlackRock with a big bias towards the United States. In the second hour of Bloomberg Surveillance, we'll catch up with Alicia Levine of BNY Wealth, John Lieber of Eurasia Group, Norman Roule of CSIS and Zach Griffiths of CreditSights. All of that and a whole lot more just around the corner with equity futures up another 1/3 of 1%.
Our number one view right now and for 2025 is volatility.
The Fed, in my opinion, has pigeonholed itself and has telegraphed too much easing for the next 12 months.
They don't have inflation in a chokehold. They need to keep their eye on the ball.
The inflation data is probably going to be a bit more critical.
This is one of those times where the Fed needs to get out of the way.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
This week is flying by quickly, and that's the way we like it. The second hour of Bloomberg Surveillance starts right now with stocks at all-time highs. Hello, Wednesday. Equity futures up by another 1/3 of 1% on the S&P 500. On the Nasdaq 100, we're shaping up as follows. On the Nasdaq, higher by 0.6 of 1%. The rally continues at the mercy of the data and some Fed speak a little bit later. You hear from Chairman Powell at 1:40 Eastern Time. Some economic data, the ADP employment report. Just another appetizer before the big one on Friday.
Yeah, and so far so good, at least when it comes to economic surprises in the United States. You do see the Citi U.S. Economic Surprise Index inflect higher once again to near the highest levels going back to April after yesterday's JOLTS data. Key question, how much strength is too much strength? How much do people start to think about maybe pausing or having the Fed not cut as much? The Fed seems to be torpedoing that talk and saying, look, we're still a far place from neutral. We need to keep lowering rates. It's just the pace of how quickly they will continue to go down.
It's interesting how many times we've heard that, and from a lot of different people. Chicago, Goolsby, San Francisco, Daly, heard it from Governor Waller as well. They really believe there's a long way to go to get back to neutral.
There is this belief that as inflation comes down, so it's not that prices are coming down, but that the pace of the rises of increased prices has slowed, that essentially these rates are getting more restrictive, and they have their eye on something that Torsten Slok actually just put a note out on, which is that the lowest income consumers are the ones getting hit hardest by rates remaining at these levels. And if you continue on that level, then it becomes a very difficult and politically fraught type of scenario to keep rates at this level, even if Wall Street is celebrating and popping the corks.
Looking ahead to payrolls Friday, the estimate in our survey moving around. It's about 218 at the moment. That's the median estimate in our survey for payrolls Friday on a headline number. For Wall Street, you'll hear a lot of one word: sequencing. The focus on Washington, D.C. is on the sequencing of policy. And I think we've got a little bit of an idea about that in the last 24 hours, where the Senate Majority Leader, Mr. Thune, would like to see things go.
Yeah, first 30 days, they want to focus on immigration. Part of that can also be because they are going to extend the spending until March. So get some immigration deal done in the first 30 days. That was part of one of the top issues. Voters came out and gave what the Republicans feel like a mandate. And then maybe when the spending issue later down the year becomes more into the forefront, when the continuing resolution ends in March, then they start talking about tax cuts. But where do the tariffs come in? That's the question.
Well, that's up to the president, and he's not going to wait around. In fact, it's already started, hasn't he? And I wonder how much conflict there is between the timeline on Capitol Hill and the timeline in Mar-a-Lago.
Well, and the timeline in markets, which is that tariffs, what tariffs? They're not going to happen at all. And that's sort of this question of at what point is this market pricing in a perfect sequencing, to Anne-Marie's point, and a sort of dialing down of some of the promised campaign speeches to lead to some kind of policy that allows this rally and those good feelings to continue. I mean, this is an actual real question for people as everyone piles into American exceptionalism.
It's a lot of good feelings, that's for sure. We're up another 1/3 of 1% on the S&P 500. Coming up this hour, we'll catch up with Alicia Levine of BNY as the S&P 500 notches another all-time high. John Lieber of Eurasia Group as Capitol Hill looks to set up Trump's agenda. And Norman Roule of CSIS as Israel carries out new strikes in Lebanon. We begin this hour with stocks higher. The S&P 500 notching its 55th record close. Investors looking ahead to more jobs data and some remarks from Fed Chair Jay Powell. Alicia Levine of BNY seeing more room for equities continues to run. We think the market melts up into year-end with a market-friendly economics team and an incoming administration with an eye on risk assets. A 2025 year-end price target is 6,600. Alicia joins us now for more. Alicia, good morning.
Good morning.
Thank you for sharing your outlook off the top of the show with us, the top of the hour at least. It's good to see you.
Thank you. We launched this morning.
This hour, I believe. 6,600 is the price target. This is a group of around 65, 66, 67. There's a lot of you. Does that make you nervous?
I think consensus makes me nervous, but it doesn't necessarily mean that we're wrong. So what we see here is the Fed cutting into a soft landing. I mean, that's really the big fundamental picture here. What gets us another 10% higher? The Fed's cutting into a soft landing. Historically, when that happens, 12 months later, the market's up about 16%. So we're into the structural time where equities will do quite well, coming in with a market-friendly administration, perhaps more volatile. And so we just think that the market can move higher here. And so with that setup, you'll have more vol because of the idiosyncratic nature of policy that you've been talking about for the last 3 weeks. So I remember those days from 2017 and 2018.
We all do.
So we're going to get some vol. I don't think it's going to be a straight line the way it was this year, but that's entirely healthy and normal. We're bullish on America, we're bullish on the market, and we think you're set up for another double-digit return for next year.
When you say market-friendly, what do you mean? Vibes or policy? And if it's policy, what policies?
So first of all, it's vibes. I think it's unmistakable. We manage wealth for large clients who have businesses in the real economy. And I did a lot of travel after the election. And I can tell you the client base with businesses, they're very optimistic and very bullish, in part because the certainty is back. The uncertainty of the 50-50, not knowing where policy was going, puts a pall on economic activity. So hiring's picking up, decisions are being made. That's great. Clearly, the extension of tax cuts is very good. The fact that the corporate tax rate will not be going higher is also very good. So that creates a market-friendly environment. Of course, the deregulation. So all that's good. What's not great is perhaps the tariffs, again, idiosyncratic, and where do they get put? I think it's safe to say the China tariffs get put on because the president can do that as part of a national security at 230. The administration can do that. If it's not national security, not clear the administration alone can do that. And so that'll create your volatility around these issues. So less market friendly, but also opportunities to buy.
You said a lot of this was predicated on the idea of a Fed cutting into a soft landing at a time where you're going around talking to different business leaders who are incredibly optimistic, who are ramping up spending, who are ramping up hiring. At what point are we talking about maybe something that looks a little bit not like a soft landing, but no landing, or something that's a reacceleration?
So I think you could say fairly that this year was kind of a no landing. We're coming in at 2.5% growth, maybe higher, to the extent that economists see trend growth at 2%. That 0.5% more is higher. So I think we've been there. I think we slowed down a little bit in the first quarter or so, because don't forget, all that fiscal spending also increased GDP, right? So if you're going to try to rein in fiscal just a little bit to try to pay for these tax cuts, that may have an effect. But I think the bond market is already priced in. We're not getting 5 cuts next year. Our 2025 outlook says 2 to 3 cuts for next year because we just think the economy is fairly strong. Calling where neutral is here, I think it seems to be much higher. I don't know how anyone can have certainty. I know there are 400 economists at the Fed, but it seems clear that it's higher than where we were during the post-global financial crisis regime. So the bond market's already priced in fewer cuts than where we thought it was a few weeks ago. And let's talk about the theme of the year. The theme of the year has been expecting many more rate cuts in the next 12 to 18 months. Then the bond market pulls it back, and the equity market moves higher anyway because growth is better than expected. That's how you get a pretty bullish scenario.
That's on the overall index level. And I guess that the difference between different strategists who are coming out, and a lot of them coming in the 66 to 7,000 range for 6,600 to 7,000 range for next year, the difference is really in the composition of those gains. And so far we've seen until yesterday and a couple days ago, an outperformance of the small caps. Do you see that continuing given the fact that tariffs are going to affect some of these smaller companies more, the higher rates are going to affect some of these smaller companies more, and all around it seems like bigger companies are just consolidating their market share?
So that's a great question. So consensus seems to have moved down the cap scale. What we're saying here is we like U.S. versus international, both developed international and emerging markets. We think we're in a strong dollar regime, so that is not great for emerging markets. China still seems to be unable to stimulate its economy to the extent to really pick up the emerging markets complex there. So we'd like U.S. over rest of world. Within the U.S., I think you can allocate more to medium and small size, but we still like U.S. large cap here precisely because of what you're talking about, which is U.S. large cap companies with the cash flow have better levers to deal with some of the tariff issues than small cap companies. So yes, on the index level, small caps have caught up and they've done great. Going forward, I think the policy mix is such where I think the large caps do better. And let me just say this, we've talked about the Magnificent Seven and large cap tech, which has not driven the market since the Fed pivoted back in July when they signaled that we're in a rate cutting regime. The rest of the market caught up. If you have those risk off days, which sector is going to act as defense? And that is large cap tech. So I think you dismiss it. It will provide stability in the portfolio in a way that small cap may not. And that's why we are still over allocated to U.S. large cap, but we like the whole U.S. complex here over rest of world.
When you look at risks to the market, you rate energy prices are risk, but WTI even this morning is below $70 a barrel, even though we have issues going on and conflict in the Middle East. What worries you?
So it's not that it worries me, it's the key variable to all of this, right? So when our clients say, wow, the world's a scary place, and also just think about what happened yesterday. We have France, we have South Korea. This was on nobody's radars for the most part. How does geopolitical risk get mediated into markets? And it's typically through the oil channel and the energy channel. So that's the variable you want to look at. We don't think there's a risk here. I think not just the deregulation in the U.S., but clearly I think some deals that may happen in the Middle East, this administration wants to see oil prices lower. That's great. It's not a certainty. And so, when everybody's on one side of the boat, you just want to keep an eye on where you could go wrong, because where you could go wrong is where the consensus is. So just keeping an eye on that.
You just gave a nod to all the political instability we're seeing. South Korea, France, Germany. Does this mean you want to double down even more on the United States?
So I wouldn't say we're doubling down because we've been there. So we've been there for 2 years. We've been overweight U.S. for 2 years. We had taken down our exposure to international both developed and emerging markets 2 years ago as the Fed was hiking rates, because our feeling was, even if we're going into a recession, where do we want to allocate our client capital? And that is in the U.S. So we're there. I'd say what interests us here is going a little bit more down the cap scale, but still overweight U.S. large cap. So in our 2025 outlook, we talk about how we still like where we've been. We're going to probably allocate more in the new year there.
6,600 on the S&P for year-end next year. Alicia, it's good to see you. Thanks
Great
for being with us.
you.
Thank you. Alicia Levine there of BNY. Equity futures up by 1/3% with some stories elsewhere. Your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. French President Emmanuel Macron is asking lawmakers to reject a no-confidence vote that would topple the government. Far-right leader Marine Le Pen and her National Rally Party have vowed to support the motion submitted by a left-wing coalition. It will pass if backed by both groups. Lawmakers will debate and vote on the motion in less than 3 hours' time. Democrat Adam Gray has won California's 13th congressional district, unseating Republican Congressman John Duarte. It's the final House contest to be called this year. Gray's victory brings Democrats to 215 seats. Republicans hold 220. Gray reportedly won by less than 200 votes. General Motors will take on more than $5 billion in charges and write-downs tied to its troubled operations in China. The automaker is attempting to save its once profitable business in the world's largest car market. According to a filing this morning, GM expects to write down the value of its JV operations in China by as much as $2.9 billion. It will also take another $2.7 billion in charges for costs to close factories and restructure its operations in the country. And that's your brief. John.
Hey, Danny, thank you. More from Danny later this hour. Up next on the program, pushing Trump's agenda.
While you may see some of these tariffs increase maybe marginally kind of day one, that there will be, they'll try to do it sort of in concert with some other things that are, maybe more risk on in terms of the tax cuts, in terms of deregulation and what have you.
We'll get to the sequencing of that policy effort in just a moment. Live from New York City this morning. Good morning. An update from JetBlue. Stock is up in a pre-market by 2.6%. The airline giving you some additional clarity on the fourth quarter, raising the outlook. Lisa, you're going to have to explain this one. The election headwind. What is the election headwind?
So basically, in the weeks leading up to the U.S. election, pretty much every travel company, hotel company, et cetera, said that people didn't like to travel. Try to explain this, go figure why people suddenly think that the uncertainty of the election should somehow make them stay home. Nonetheless, basically, there was a restraint in travel. So that was the headwind. But then the revenge travel after the election, they said the booking performance for travel in November and December was higher than expectations immediately following the U.S. election because that's done. OK, now we can go travel.
OK, that makes sense. Kinda. The stock is up in a pre-market by about 3% following that update. Under surveillance this morning, pushing Trump's agenda.
The economic direction of travel here's a little bit mixed. What we understand from the Trump transition team is that there is going to be attention to the sequencing of various economic policies. So while you may see some of these tariffs increase maybe marginally kind of day one, that there will be, they'll try to do it sort of in concert with some other things that are maybe more risk on in terms of the tax cuts, in terms of deregulation and what have you.
So here's the latest on that sequencing. Incoming Senate Majority Leader John Thune looking to pass a budget reconciliation bill early next year, focusing on border security, defense and security. Thune telling Senate Republicans he wants to postpone a tax-focused bill until later in 2025. John Lieber of Eurasia Group joins us now for more. John, you heard there from Libby Cantrell of PIMCO just moments ago talking about the word tension. Can we ask you, how much tension there will be over this between Mar-a-Lago and Capitol Hill?
Well, on the legislative agenda, they're united. I mean, this is not unusual that, a president comes in and he's got unified Congress. We've seen it with Biden, Trump, Obama, and Bush now. And in that combination, when it happens, they tend to come in with the head of steam and they get big things done. Bush did a big tax cut. They did education overhaul with Democrats. Obama did a big stimulus bill. He did healthcare. He did financial sector reform. Trump did a big tax cut. Biden did a big stimulus bill. And these things can happen really fast. Republicans are united around the elements of the Trump agenda they support, mainly immigration, energy, higher defense spending, extending the Trump tax cuts. And, it could move quickly because the politics at the big level aren't that high. At the high level, they aren't that strained. But when you get into the details is when things get really hard. And that's what ends up delaying an agenda like this, I think, probably to later in the year.
But is that why potentially you have immigration first out of the gate, John Thune wants to do in the first 30 days and wait on tax? Because you think there's going to be more of a discussion and negotiation when it comes to tax cuts?
I think the challenge with the tax cuts is the cost. And, $4 trillion to extend the Trump tax cuts that expire at the end of the year, it's not nothing. And they just haven't come to terms with how much of that they need to offset with other spending cuts. The other plans they have for the border, for defense, these are probably in the low, mid tens of billions, maybe in the hundreds of billions of dollars of a 10-year cost, which is how Congress budgets things. But the tax bill is real money. I mean, these are trillions of dollars. I think they probably end up not offsetting it, but it's just clear they haven't had that discussion and they don't know exactly what they want to do on the tax side. I think that makes it a little more difficult, whereas these other issues are a little easier. Honestly, I'm a little surprised at the sequencing. I would have thought tax is something they basically agree on, keeping current law where it is, making sure nobody gets a tax increase. That should be pretty easy for Republicans. But the fact that they're talking about delaying it suggests there's more dissension among them than is obvious.
When it comes to paying for that tax bill, is it going to be the tariffs, or do you view the tariffs as potentially a lot of bluster at first, but they're going to end up being a negotiating tool?
I think tariffs will be higher. Trump has said he's going to raise them. He's already kind of laid out a plan for 3 countries to raise them on: Mexico, Canada, and China. But it's interesting, if you look at those 3 countries, Mexico and Canada came immediately down to Mar-a-Lago to sit down with Trump and probably will end up finding a way to negotiate out of those tariffs, whereas China's taking a more of a wait and see approach, which could mean that those tariffs end up being the ones that are implemented on day one. So, I think the tariffs are both. They're both a negotiating opportunity, but they will be higher by the end of next year. We just don't know how much. And if it's significant, then that gives, if it's hundreds of billions of dollars over a 10-year period, which I don't expect, but if it is, that gives the Republicans in the Congress an opportunity to use that revenue to offset the tax cut. And if it's smaller, then they have to ask themselves, how much of a deficit hit are they willing to take?
John, when it comes to this raw power we see Donald Trump use right now, whether or not it's already negotiating tariffs with the likes of Justin Trudeau, or also reiterating that he would kill the Nippon Steel, U.S. Steel deal, what does this mean for President Biden when it comes to not just the outreach on foreign policy, but this deal right now that remains in CFIUS control?
Well, it means that Biden's term has ended 2 months earlier than expected. And I think, Trump's clearly the person that world leaders want to talk to. Biden doesn't, Biden could do a couple of interesting or significant things between now and the end of the year. They're pushing for additional funding for Ukraine. You could see maybe several $1 billion going to fund that war effort. Biden could approve the Nippon Steel deal. We don't think he will, but he might. Trump has reiterated, this is an influx issue because the unions are starting to get more worried about losing their jobs if the deal doesn't go through due to the lack of money that U.S. Steel has coming in. And Biden still has the power to say that if he wants to. It would surprise me. That would be an unexpected kind of parting shot at the organized union labor that supported him during the campaign. Some of them supported him. But it's still in his power if he wants to do it. I just don't think he will.
John, on a broader level, right now the market has moved on, as you've talked about. People are looking to Donald Trump as the president-elect, or the president even, as they have some negotiations. And there seems to be this euphoria around policy certainty. At the same time that a number of nominees that Donald Trump has put out there have already stepped down. I'm talking about Pete Hegseth. That's the latest, potentially from the Wall Street Journal. That might be. Matt Gaetz was the first. How much do you think that people in the market are overstating how much of a well-oiled machine this actually is and how much policy is actually going to get through?
Well, I think on the things that matter, there's a little bit more certainty, right? So the big things that are going to move the markets next year are probably going to be immigration, tariffs, and fiscal. Fiscal is going to remain loose. Immigration numbers are going down, and on tariffs are going up. So we know that, but what we don't know is the magnitude. And I think that it's still possible and probably likely the magnitude of each of those things ends up being higher than anticipated. On fiscal policy, yes, it'll remain loose. I don't think there's big tax cuts coming. The immigration numbers could be big. It won't come as a shock, like a one-time shock to markets, because you're not going to be deporting 10 million people all at once. But there will be this slow drip in the labor market as it tightens next year, as they get to somewhere around 1 million people being deported per year, is our guess. And then on tariffs, that could be a bigger shock than anticipated right now. I think the fact that Trump seems to have put in place a more market-friendly cabinet is probably allowing market participants to think that this is probably not going to be as bad as it looks. But tariffs are Trump's favorite tool, and directionally they're going up. That shock is probably the one that could be the largest next year that's not priced in right now.
Just quickly, John, will the Trump administration have the finances to do these mass deportations?
Yeah, I mean, this is one of the reasons Thune wants to move quickly on immigration, is because they're going to be able to give significant, probably tens of billions of dollars in additional resources to the southern border, to CBP and to others to help with the deportations. There's going to be a lot of pushback. They've got to detain a lot of people. They've got to find a lot of people. And they're not, in some states, they'll get cooperation from local law enforcement, and others they won't. So that effort's going to be messy. But, 500,000 people deported a year is not that unusual in recent U.S. history. And I think it should be pretty easy for the Trump team to get there next year and go beyond that in 2026.
Hey, John, it's good to hear from you. As always, thank you. John Lieber there of Eurasia Group on the sequencing for next year and the little bits of tension here and there. And the fact you might have to wait for that tax cut. Look, the Tax Cut and Jobs Act of 2017, you extend that, it's expensive enough. What about everything else? Taxes on tips, SALT deduction, all of the above.
The extension isn't actually a tax break, though. That's what we're learning. That's just simply instating the actual policy that exists. So maybe a marketing quirk can allow some of those tax cuts to disappear.
It's a lot to figure out in the next 12 months or so. Up next, we'll catch up with the former senior U.S. intelligence official, Norman Roule. We are 2 hours away from the opening bell. Equity futures right now adding some more weight to this year's rally. Up another third of 1% on the S&P 500, up 0.6 on the Nasdaq 100 with your morning movers. It's Manus Cranny. Good morning, Manus.
Jonathan, good morning. Pump up the margins, pump up the revenue. That is the message from Salesforce this morning. Your CRM provider with a sprinkling of AI. It is the magic words. The revenue is up over 8% at $9.44 billion, but margins 33.1%, and a message from the C-suite. Good number of deals signed on the Agentforce, that is their AI product. Piper Sandler liked the message so much that they've upped the game to $405 on the stock from $395, and they say this is a robust multi-cloud adoption. Have a look at Big Pharma. We've got a lot of political issues going into 2025, but Merck is worth just taking a note of. It's been upgraded by HSBC, $130, so there's 28%, 30% left in the upside. What they say is the valuation at the moment leaves a significant margin for safety. And also one of the big drugs that they have, one of the big cancer vaccines in China, as they say, is stabilizing, and you need to take note of that. Everybody hopes that the great adventure in China will reap great rewards. Mary Barra has decided to be very pragmatic today. She's taking a hit on the joint venture in China. That's SAIC, 50-50 joint venture. It's going to cost them $2.7 billion to close factories, to restructure, and to deal with the reality that Mary Barra says, which is domestic brands in China are not prioritizing profitability, Jonathan. There's no shock there. They prioritize production, market share, and the full backing of China. And that is the differentiating factor here in terms of the adventure, the misadventure, and the cost of pain of doing business in China. Good morning, Jonathan.
And emerging national champions at that. Manus Cranny, thank you. I think Jay Pawlowski coined the phrase the tripolar world when he started to think about these issues. And we're seeing that across the board for the auto manufacturers in places like China, in Europe, in the United States. They seem to be retreating to home base. And in certain places, the United States, for example, the government is very comfortable with that. They're just willing to put the walls up and protect them at the same time.
So which industries are able to go to home base and can sustain themselves on local production, and which can't? And this raises the question about the likes of Apple. It raises the question of other companies, Qualcomm, that have been really interlaced with Chinese production and just sales in general. It becomes a real big question as we talk about decoupling at a time where the two biggest economies in this world are intricately connected.
So I think there is one home base that's better than others, and that's the United States of America. If you have to retreat to America, that is a good thing. If you have to retreat somewhere else like Europe right now, with the economy not doing so well, very different proposition.
Which raises the question about GM and the fact that, as you pointed out, their shares are up some 50% so far this year, at the same time that you have the likes of Volkswagen and Stellantis absolutely being hammered because they're facing a 1-2 whammy, where essentially in China they have a competitive disadvantage, and in their home market they don't necessarily have the ability to sell as much as they're producing.
Let's get to some other company stories. Under surveillance this morning, the latest on retail. Foot Locker cutting its full-year sales and profit forecast, citing more discounts and a pullback in consumer spending. This is Dollar Tree reports better than expected earnings, also announcing the departure of CFO Jeff Davis. That stock is up by 3%. But just to get back to Foot Locker in the pre-market, Bramo, getting hammered.
Yeah, at a time when Foot Locker's been trying to turn itself around after, remember, trying to move away from some of the big brands, the Adidas and the Nike, and that didn't really work. So now suddenly they are trying to rejigger. But what this highlights to me is you're seeing market share cannibalization, and you're seeing that become more and more entrenched, and the winners and the losers are becoming much clearer. And I think that that's fascinating at a time when, frankly, you can't make a big macro story out of one name, especially one that's been struggling for a while.
Well, when you look at the CEO statement, they talk about this more cautious view because there's a more promotional environment and softer consumer demand outside of key selling periods. What's more key selling period than up until the Christmas holiday season? This is when they should be doing well, and they're seeing a pullback ahead of December, ahead of, Christmas, Hanukkah, Thanksgiving. It's pretty incredible, and you have to think, how's 2025 look?
Alicia alluded to this. This has been a problem for a while over the last several years. Nike was a key partner. They deprioritized retail partnerships like the one with Foot Locker. That hurt them. There's been a lot of volatility in this name. I think we always take a step back for the retail players and we think, does it tell me something about the consumer or execution? Is it one or the other? And I think, Lisa, that's what you're getting at.
Especially with the juxtaposition of Dollar Tree. I know they're completely different companies, but we saw some retailers do very well. We saw TJ Maxx do very well. We saw Gap do well. We saw a whole host of names come out with better than expected earnings and consumers that were anything but particularly cautious. With Foot Locker, I think that you're onto something, and you're seeing this dramatic shift with, do some of the brands sell direct to consumer? How much do they need the platforms? Where do they need the stores? And I think that that really is where this story lies.
Foot Locker down double digits in the pre-market trading so far. We're down about 14%. Let's turn to the politics. French President Emmanuel Macron calling on lawmakers to reject the no-confidence vote that could topple the government. The right-wing National Rally Party vowing to support the motion submitted by a left-wing coalition in response to Prime Minister Michel Barnier's unpopular budget bill. France isn't the only place where you're seeing instability. In South Korea, the opposition party calling for the impeachment of President Yoon after he briefly imposed martial law. Opposition parties saying they'll also pursue treason charges against Yoon, and the defence and safety ministers alleging the declaration of martial law was illegal.
So there's a lot of political instability around the world. And I think what's so interesting about South Korea is actually this was working with President Yoon. Remember, this was the president that came to the United States and was singing American Pie at the White House for a state dinner. They were able to work on trilateral engagement between South Korea, Japan, the United States. This was a foreign policy achievement. And now this individual is going to be facing impeachment charges.
Well, all I can say is he miscalculated on every level you could possibly imagine. He came out and said, this is it, military rule, no fake news, stop reporting anything on politics. And reporters were like, whatever. And they continued to actually get a consensus against him pretty much across the board. Just not to find some silver lining. But if anything, maybe the takeaway is no way are people going to accept this in South Korea. On a larger scale, this might actually mean a more friendly relationship with North Korea, which has more geopolitical consequences. But in the short term, it doesn't seem like this is a democracy about to be toppled.
Well, the reason why he had martial law, if you look internally at their politics, you get a 5-year term as president, and he's due in 2027. And he's been trying to enact change, get legislation through, and he hasn't been able to do it. The only way he could potentially get some of the bills he wants through was to have martial law. So he probably felt like, I'm just going to take this gamble, see if I can even get a bill, one through, but it backfired in a grand scale.
Lasted about several hours?
6.
6 hours. Some volatility once again over in South Korea. Let's get to some real volatility in the Middle East. AP reporting Israeli forces carried out several drone and artillery strikes in Lebanon yesterday. Israeli Prime Minister Benjamin Netanyahu saying Israel is enforcing the Lebanon ceasefire with an iron fist, acting against both serious and minor violations from Hezbollah. Joining us now, Norman Roule, the former senior US intelligence official. Norman, welcome to the programme, sir. In your experience, are things like this, breaks in the ceasefire, episodes like the one we're seeing play out overnight, are they normal or is this out of the ordinary?
Good morning. The ceasefire between Hezbollah and Israel was expected to be shaky. It continues to hold. It is a ceasefire of sorts in that you have Hezbollah and Israel each launching limited strikes against each other. The United States remains displeased, along with the French, with Israel because it is not using the system that was set up to address Hezbollah violations. But the Israeli posture on the region has changed. It's not going to rely upon what it believes to be a slow and ineffective international community. And it will, if it sees activity by Hezbollah, it will attack that activity before Hezbollah is able to build positions, move in weapons, etc. I think this is going to be a bit of the new normal for this ceasefire for a while until each side is able to basically test the other's limits, and the Lebanese government is able to place its forces in the south to separate these two sides.
Norman, when it comes to what is going on in Gaza, we have President-elect Trump and President Biden both saying the hostages need to be released. Has Hamas shifted its position at all for there to be any opening in a ceasefire agreement?
No, Hamas's position has remained consistent. It has called for the withdrawal of Israeli forces from Gaza, the withdrawal as part of that of Israeli forces from the Philadelphia corridor along Egypt, where tunnels had existed to allow Hezbollah to move personnel and weapons in and out of Gaza. And last, that Hamas have no restrictions on it as to where it can move its forces inside. For Israel, in essence, this means losing the war, Hamas restoring its control over Gaza. At the same time, within Israel itself, the Israelis continue to believe a military option is important and the way to go in Gaza. There is some evidence they're setting up military installations in the north, and the U.S. has complained about this. I don't see a significant shift taking place in Gaza in the near term.
I also want to ask you about what's going on in Syria. How weakened will Iran be and their proxies, whether that's Hamas, Lebanese Hezbollah, if Iran loses its stronghold in Syria?
The loss of Syria for Iran would be catastrophic. Syria is Iran's only state ally. It has been a decent partner for Iran since the days of the Iran-Iraq War, and Iran requires the territory of Syria in order to shift weapons into Jordan, shift weapons via Jordan into the West Bank, and of course to provide training and weapons flows into Lebanon. Last, Iran is able to use Damascus as an air hub. So it brings militants, to include the Houthis, to Syria, puts them on a plane in Damascus, sends them to Iran for extensive training and ideological vetting. So the loss of this territory would be a significant pressure on Iran's entire proxy architecture.
Norman, is there a takeaway that it just took days for rebels in Syria to topple some of the Assad regime in key cities after years of fighting, after the removal of the pressures of Iran, but also with Russia? It's sort of a perfect storm of the Ukraine-Russia war, as well as what's going on with Israel and Gaza and Hezbollah. How much is this just the beginning of a certain percolation of other conflicts in regions that have essentially been hosts to proxy wars between Iran and Russia and the West?
A great question. So what we've seen in Aleppo is that the Russians, the Iranians, and the Syrians each suffered a significant intelligence failure. They did not see Hayat Tahrir al-Shams, the opposition group that took Aleppo, prepare for this attack and infiltrate the city. Right now, the rebels have moved, or the opposition have moved south, and they're now pressuring Syria's fourth largest city, Hama. Hama and Homs, about 24 kilometers south, are critical to maintain the connection line between Damascus and Russian bases on the Mediterranean. What you're looking at is a system that is eroded, not just in intelligence, but in its response capacity. Russia is now responding traditionally with airstrikes, to include reportedly on hospitals, much as it did in the past. You're going to see Iran move personnel and weaponry, shift its Afghan and Pak militias in Syria, and bring in elements of Iraqi militias into country as well. But what you're not going to see is a large Hezbollah portion from Lebanon. We're seeing a region that has changed. I would caution that it's too early to say that the Assad regime is going to collapse, or that the Quds force in Iran is going to lose its control of Syria. These are early days in this conflict.
That said, Norman, the fact that you're seeing this sort of rejiggering in political force in the Middle East comes at a time that we're talking about developed markets struggling with government dissolution, whether it's from South Korea and what that means for North Korea, whether it's France, what that means for the support of Ukraine. What are the hotspots you're looking at to potentially be new nodes of conflict as you do see this political turmoil around the world and a changing in the geopolitical order?
Yemen remains the most prominent potential hotspot. The Houthis have maintained their architecture. They are available for Iran to replenish, retrain, and reposture. They are geographically located on a major trade outlet, the Bab el-Mandab, and they're able to threaten the prosperity of the Gulf Cooperation Council with missile and drone strikes. Yemen is a problem that the world has ignored, and I believe it will pay the price for doing so in the future. In terms of Syria, Lebanon, perhaps Libya, and other the broken states of the region, we're seeing more of the same. I would say that you're watching the Saudis, the Emiratis, continue their efforts to see if they can pull Assad from Iran into the Arab fold. This is difficult. And last, you are seeing the Gulf Cooperation Council, particularly the Saudis and the Emiratis, with their engine of prosperity and transformation through technology, try to improve conditions from throughout the region and in Africa. And I think there's a positive story there that should give us hope for the region and its ability to calm a number of conflicts.
When it comes back to the Houthis, though, Norm, do you see sufficient deterrence from the world stage, from the United States?
I see no evidence of deterrence. The Houthis continue to conduct attacks against American military shipping and American shipping. The United States has successfully, with its partners, defended against those attacks. And the United States, with its partners, has successfully degraded considerable elements of Houthis' capacity. But they continue to fire. And the definition of deterrence is that they would stop firing. What we're watching is a policy that did not prioritize deterrence play out.
Norman Roule, always fantastic to get your perspective and insights, sir. The former senior US intelligence official. On that final point, a very important point, a big challenge for the incoming administration to re-establish deterrence once again in the region.
Especially when it comes to Norm's point, the Houthis and the Red Sea. The fact that you still have Western vessels unable to use the Red Sea because they are concerned about Houthi rebels. Also, watch Syria. Norm's point, if Iran loses a stronghold in Syria, what does that mean in terms of Iran being able to support their proxies, whether that's Hamas or Lebanese Hezbollah?
A new front in a fragile region. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Trump's pick for Treasury Secretary Scott Bessent plans to meet this week with key Republicans as he begins preparing for confirmation hearings. Sources say the veteran hedge fund manager will meet with Senate Republican leader John Thune later today. A spokesperson for Trump's transition team says that Bessent also plans to meet with other key Senate Republicans, including the incoming number 2 leader John Barrasso this week. Meta is seeking up to 4 gigawatts of new nuclear energy for its data centers. It's looking for proposals to deliver reactor capacity starting in the early 2030s. The announcement also follows similar ones from Alphabet, Amazon, and Microsoft looking to invest in reactor tech to power their AI offerings. Shares of Eli Lilly moving higher by more than 1% in the early trade. Lilly reporting that its blockbuster weight loss drug Zepbound outperformed rival Novo Nordisk Wegovy in the first head-to-head trial. It was a study sponsored by Lilly where people treated with Zepbound lost an average of 20% of their body weight over 72 weeks. Those who got Wegovy shed 14%. And that's your brief, John.
Hey, Danny, thank you. More from Danny in 30 minutes' time. Up next on the program, setting up for a December cut.
I view the economy as being in a good position after making significant progress in recent years towards our dual mandate of maximum employment and stable prices.
That conversation up next, live from New York. This is Bloomberg TV. Two stocks to watch this morning. Here's the first, JetBlue, lifting its outlook. Better bookings, better fees. Better stock price reaction. The stock is up by close to 5% in early trading. Turn that story upside down and you've got a good idea of what Foot Locker looks like. Foot Locker down by close to 14%. They've had to cut the outlook. How many times have we heard this kind of language from a CEO in a retail sector? The consumer is being choosy, picky and smart, trying to find the best deals that they can find.
Yeah, choosy and picky with their products in their particular sector. And that's sort of the question. How much is this a broader macro story? How much is this a marketing play and an execution issue? And that's what a lot of investors are trying to figure out.
We'll speak to an analyst from BTIG in about 25 minutes' time. Don't miss that conversation. That stock getting hammered. Now down by close to 16% in early trading. Under surveillance this morning, setting up for a December cut.
I view the economy as being in a good position after making significant progress in recent years towards our dual mandate of maximum employment and stable prices. The labor market remains solid and inflation appears to be in a sustainable path to our 2% goal.
So here's the latest this morning. Fed officials are leaving the door open to reduce interest rates this month. Zachary Griffiths of CreditSights expecting Fed funds to finish 2025 in the 425 to 450 range, writing, "We see this playing out in one of two ways. The first path includes a cut in December and a long pause throughout 2025. The second involves the Fed cutting for the next several meetings and eventually reversing course in the second half of 25. Zach joins us now for more. Zach, good morning.
Good morning.
Are you saying hikes if they keep cutting?
We see that as a potential outcome depending on the policy initiatives of the Trump administration, and we're taking them very seriously in terms of tariffs and what they're going to do with migration policy. And so we think that you could have an inflationary impulse from both the labor market and from these tariffs that we think are going to be coming in this incoming administration early on. So we're focused on some of the market negatives in terms of the incoming Trump agenda versus the market positives, which seem to be really holding the day so far.
When we talk about neutral rate, and that's sort of the goal here, is to try to understand what is neither restrictive nor stimulative to an economy that seems like it's just fine. Is this policy restrictive for the investment grade and high yield companies that you cover?
That's the big question, Lisa, that we've been grappling with. And when we look at what you're seeing in the market right now, demand has been very strong. Deals are getting done at extremely tight spreads. And so we've had to reconsider how tight is policy. I think you are seeing some instances in the economy where interest rate sensitive sectors are taking a bit of a hit. But when we think about going forward, I don't think the Fed is in a position to cut as much as the market is priced for if we get this policy mix that we're anticipating. So when we think about what does that mean for investors, we think you have fiscal policy that's going to push yields higher and potentially spreads wider as fundamentals come under pressure, while at the same time you don't have that monetary easing bias that really buoyed markets throughout 2024.
Sorry for a basic question, but some people are arguing that lower rated companies are struggling the most with these high rates, and they're going to have to refinance, and that they're struggling, and that they're not as profitable. And some people could argue that's capitalism, right? That essentially, if you don't have profitability, then you can't borrow as much money, and then you're going to struggle. Why is it actually a problem versus the way that markets were supposed to work after years and years of basically the Fed funneling out free money?
Maybe it isn't. And I think that really comes down to our idea that it's going to be more about credit selection in 2025. So there are going to be some names that are yielding elevated levels that perhaps have a better business model, can get deals done, but you need to avoid the ones that these higher borrowing costs that may be a reality for much longer. They're not going to be around in the next couple of years. You don't want to be owning that debt now.
Didn't we stop playing capitalism 20 years ago?
I mean,
didn't that end?
I mean, that's the issue. So if people thought that, then, essentially the Fed put means that we go back to that. And that's sort of the key question here.
What would constrain the Fed put? And that's inflation. Do you see inflation sticking around to an extent that it would constrain the Fed put?
That's what we're concerned about. And when we look at the near-term path of inflation, we see core PCE stuck around this 2.8% level, perhaps coming down around the middle of the year. And then depending on the policy mix that we get, perhaps accelerating again in the second half of 2025. And that's where you could see rate hikes coming back on the table. I think that would be a pretty big market negative, again, as we've had this backdrop of an expectation of more cuts from global central banks buoying fixed income.
I hate to get really specific about it, but you saying a cut in December, then a cut in March, and they have to think about hiking. How many cuts do you think would be the mistake? 1, 2, 3?
Well, timing it is difficult. And I think when we're talking to our clients, our call right now is you're going to get less in terms of cuts in aggregate in 2025 than what the market is priced for. So that keeps borrowing costs higher for longer. We think that pushes yields higher across the curve, maybe a little bit flatter than what the market is currently priced for. And so when we think about what do you do in that environment, we think up in quality and shorter in duration.
I like how you dodged the question. Zach, thank you. You're out of time too, so I can't follow up. Zach Griffiths there at CreditSights. Not the first to tee up the prospect of interest rate hikes in 2025.
Because of the potential for this to be an inflationary policy mix, there's a lot of unknown. Despite everyone's euphoria around American exceptionalism, there still is a lot to be determined in terms of sequencing what actually gets through and the muddle that is 2025.
I got coming out of the pandemic wrong because I was so focused on waiting for credit problems and never came around. Sat here waiting for them. Didn't happen.
Well, I think that you can pretty much join all of us because basically everybody got it wrong. So.
I know you were on the same page as me.
I know, we have both got it wrong.
Other people were far more optimistic. Zach, it's good to see you. Thank you, sir. In the next hour on Bloomberg Surveillance, Dan Suzuki of RB Advisors, Janine Stichter of BTIG, Ian Shepherdson of Pantheon Macroeconomics, and Ian Lyngen of BMO.
Market really cares ultimately about revenues and earnings.
The key thing that equities need is strong growth.
If we were to get in a situation where investors are spooked by the bond market, you could easily see pretty good sell-off.
We take up the backup in bond yields as an opportunity.
What history tells us is that periods of exuberance can last for a long time.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
So we're 90 minutes away from the opening bell. The scores look like this. Equity futures are up by 0.25% as we come into Wednesday once again at all-time highs. This is a frustrating feature of earnings season for me because you can cherry pick a single name and then tell a big story. So let's take, say, JetBlue. JetBlue tells you everything's great. Bookings are up, fees are okay. We're raising our outlook. The stock is rallying. We're up 5%. Consumers doing really, really well, according to JetBlue. Take a look at Foot Locker. Foot Locker's telling the consumer is picky, it's choosy. We're not doing so well. The stock's getting slammed by 17%. Is this about company execution? Is it about industry? Does any of this tell you anything about where the U.S. consumer really is?
I actually think it does. And I actually think that these two stories are fascinating because right now JetBlue is also gaining from their shift to try to cater to a higher end consumer. Their premium offering is also gaining some momentum and increasing some of their profitability. They also have benefited from oil prices being suppressed. On the flip side, Foot Locker isn't as exposed to the high-end consumer that the likes of JetBlue is trying to get itself exposed to, so they are more susceptible to little hiccups in a strategy that already has struggled quite considerably over the past few years.
That stock is down 17% in pre-market trading. If things are murky looking at the earnings, unfortunately there will be when it comes to the data as well. We'll get the ADP report in just a moment. On Friday, we'll get the payrolls report. You'll hear from Chairman Powell at 1:40 Eastern. One part of his challenge is to try and strip out the bounce back that everyone's expecting. This is what we heard from Bank of America. Aditya Bave put this out yesterday. We estimate that the hurricane took at least 60K off October payrolls. Strikes, which have mostly since ended, accounted for an additional 41K drag. Therefore, November and a payrolls report should reflect about 100K of payback or more. So whatever we get on Friday, you've got to strip out 100K maybe or more.
Which maybe is the reason why what you've heard from Fed officials is just lowering the bar all week. Okay, it's not necessarily that we need to see weakness. We just need things to be on course in a way that's not inflationary for us to take away some of the restraint that we see on the economy toward the neutral path. And that's the reason why you're hearing all this rhetoric saying we're still kind of looking at rate cuts, even if we do get a big number on Friday.
Well, I'm so interested in what Chair Powell has to say today, because when he last had this public appearance, this is before the quiet period, on November 14th, he said the economy is not sending any signals that we need to be in a hurry. What will he say today, given we are so close to the next meeting? Is he going to start to maybe drift back from this idea of we don't need to be in a hurry if everyone else is almost lining up for December?
Chairman Powell, 1:40 Eastern Time, the ADP report at 8:15, so about 12 minutes from now. Coming up this hour, we'll catch up with Dan Suzuki of RB Advisors as the S&P 500 squeezes out a 55 record close. Janine Stichter of BTIG as Foot Locker sees a softer consumer, and Ian Shepherdson of Pantheon Macroeconomics looking for muted November payrolls. We begin this hour with stocks higher, the S&P 500 posting another record high as traders await remarks from Powell and payrolls on Friday. Dan Suzuki of RB Advisors saying the market narrative seems to swing between extreme bullishness and bearishness. Investors should fade both extremes. Even as the narratives have shifted from pessimism to optimism in a matter of months, months. Underlying growth has been quite steady all year long. Dan joins us now for more. Dan, good morning. Are we at an extreme right now that we need to fade?
I think we're getting there. I mean, if you think about it, everybody's getting bullish on the growth outlook, at least in the U.S. And that's why people are a little bit worried about inflation, because growth is so good, and then you're going to have all this fiscal stimulus at our backs. I think people are getting toward extreme optimism.
You've been looking at small caps. Small caps ripped in the month of November, double digits, just like they did in November 2020, just like they did in November 2016. Is that a place you still want to be?
I think so. For the time being, I think it makes sense. I mean, you got to think about the current environment as who's going to benefit most from accelerating nominal growth. And I think that small caps is one of those beneficiaries, among others. And I think that's a great place to be, where you're getting paid to take that position.
So we were looking at some of the earnings, and John made a great point. How do you come up with a bigger story and a bigger thesis from very different earnings pictures, depending on the companies? What do you make of the increasing dispersion that we're seeing between the winners and the losers of this earnings season?
Yeah, to my perspective is actually the dispersion among winners and losers is actually decreasing. I mean, if you think about it, like a year ago, there was only like a handful of winners, and that was it. And then more and more, every earnings season that we go through, more and more companies are putting in better growth. So you still have those winners and losers, and you're always going to have them. But I would say that there's more winners than losers these days, and the winners are the ones that are geared toward the improving nominal growth environment.
How do you hedge yourself against exuberance that you do see building in markets?
Well, just don't get too far over your skis. I mean, one of the things that we've been pointing out is that people's optimism is getting pretty extreme. I mean, the Conference Board survey is saying that the record number of people think stocks are going to go up. Household equity allocations, people don't seem to realize this. Household equity allocations are at an all-time high, right? So I think the thing is that people have a financial plan for a reason, but people forget the financial plan during times of extreme. So when things are bad, they want to sell everything, and when times are good, they just let it ride. And I think that the whole point of a financial plan is to sort of smooth out those ups and downs.
You have this new report out talking about the $7 trillion on the sidelines. And you say, actually, when you look at more nuance, historically, that's not a lot.
Yeah, well, first of all, I think the whole point I put out that piece was just to put shed a little bit more light, because I think there's a lot of headlines and numbers being thrown around with not a lot of understanding. So $7 trillion in money market assets is like getting a lot of headlines, but the reality is that household cash levels are almost triple that amount. Basically, $19 trillion is the annual revenue of the S&P 500. It's like 3 years of government spending. So it's a big number, but when you put it in perspective of household allocations, it's actually down, because while cash allocations have gone up almost 40% over the last 5 years, stock exposure has gone up over 50% over the last 5 years. And so, the percentage in cash is actually below history and down relative to 5 years ago.
Where do you see a lot of that cash going?
Yeah, so I think that the cash it's not like it's going anywhere, right? It just hasn't kept pace with, stock allocations and things like that. But where it is taking share, maybe a little bit over the last few years, is relative to bonds, because bonds, have seen the biggest drawdown in history, almost 50%. And so people don't like it when the things they own go down. They like to own less of it. Cash has done really well. They tend to own more of it. So cash relative to bonds has probably gone up a little bit, but relative to stocks and everything else has actually gone down.
This actually goes to the heart of what you were talking about before, which is when you have a financial plan, it's trying to even out some of the extremes on all sides. Is the way to even it out with cash rather than bonds at a time where inflation could be one of the biggest risks to this entire scenario?
Yeah, I think as you think longer term, I mean, the whole point of a 60-40 sort of stocks bond portfolio is because bonds is the diversifier, but that works extremely well in a falling rate secular environment. If we're right, that's no longer going to be the case going forward. And so the times to own bonds is really that cyclical protection. If you're going into a major slowdown, you want that cyclical diversification. But outside of that, you probably do want less bonds in your portfolio, because higher rates is not good for bond prices. So if you look back to like the 60s and 70s, not that we're going into that, but just a higher and rising rate environment, cash actually did extremely well.
At a certain point, are you looking at the risks to this euphoria as being more heavily balanced to a reacceleration or an inflationary type environment rather than that cyclical downturn where bonds would actually provide you some sort of haven?
I think in the near term, that's correct. I mean, I think that you have cyclical and secular forces that are putting upward pressure on inflation. I think right now, that's good for nominal growth. You could get to a point, and you were discussing this earlier, what's the Fed's response going to be to that? And at some point, they may step in to sort of pull the punch bowl away and bring forward that potential cyclical slowdown. So you have to be a little bit nimble here, but I think for the time being, all signs point to stronger nominal growth.
How policy dependent is this call for next year? Is it dependent on the incoming administration doing certain things? Do you have any sort of underlying assumptions?
It's not policy dependent. We don't tend to be event driven. And if you look historically, trying to invest based on policies is the road to ruin, right? I mean, just in this administration, you should have bought, solar and wind, and dirty old energy was the best performing stuff. And you can do that with every administration.
Well, you like energy for next year, which is where this conversation was going.
Yeah, I do. So I think that policy is not the story. But even if you read through the policy, the thing that I like is that it just reinforces some of the cyclical and secular stories that are already in place, right? When I look through tariffs or tax cuts or immigration policy, what I see is pro-inflation. And I think that's already going to be the case regardless of whether you have those policies or not.
Dan, it's good to see you. Always great to catch up. Thank you, buddy. Dan Suzuki there of RB Advisors, talking about that reflation. Yields are higher by 4 basis points on a 10-year. Near the highs of the week so far, 427 on a 10-year at the moment. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. JetBlue shares higher by nearly 4% in the pre-market trade. It boosted forecasts for fourth quarter results. It also posted higher than expected bookings in November and December, as well as lower costs thanks to falling fuel prices. Under its new CEO, JetBlue said that it will pull back to core markets in Northeast and Southeast U.S. and Puerto Rico, hoping to reduce expenses and boost sales after a failed expansion. Meanwhile, on the other side of things, Foot Locker shares plunging more than 15% pre-market. It cut its full-year sales forecast and profit forecast. The footwear chain pointed to an overall pullback in consumer spending and shoppers trading down in favor of discounts ahead of the holiday season. CEO Mary Dillon said the company is focusing on a turnaround plan, renovating a large portion of its stores, prioritizing a rewards program, and revamping digital operations. The matchups are set for the NBA Cup quarterfinals. The first round of knockout games tip off next week. The Knicks host the Atlanta Hawks after beating the Orlando Magic. Orlando will face off against the East #1 seed, the Milwaukee Bucks. In the Western Conference, it'll be Dallas at OKC and Golden State at Houston. And that's your brief, John.
And nobody cares, Danny, and that's important. And I'll tell you why. I know some people care. But TV ratings are down for the NBA, and I wonder if there's a link here between that story and what's happening with Foot Locker, basketball culture at large, whether maybe that's not in vogue right now, and that's why they're struggling.
Or maybe it's because they're all watching the women's basketball teams, because those already took a lot of the oxygen out of the room.
Those TV ratings are up.
Exactly. So
that is true.
I'm just throwing that out there.
It's an important counterpoint that I'm happy to entertain.
Okay, great.
We can have that conversation in a moment with Janine Stichter of BTIG as Foot Locker reports after consumer spending comes in a little bit softer over at Foot Locker. That stock is down by 16%. Your ADP report drops next. The ADP report is seconds away. Equity futures right now in the S&P just a little bit firmer, up 1/3 of 1% after closing yesterday at all-time highs. As we look ahead to the payrolls report this Friday, the median estimate in our survey is 218, looking for a big bounce back from the really soft 12K in the month of October. Looking for the ADP report, the estimate this morning is 150 with the number. Here's Michael McKee. Good morning, Mike.
Good morning. Well, we come in a little bit lower than 150, but pretty darn good estimates today because we get 146,000 jobs found by ADP during the month of November. Now, that is a significantly lower number than the 223 they had found the prior month. And of course, we only got 12 out of the non-farm payrolls. So we'll see what happens when we get the number on Friday. A lot of questions about how much noise is in this data and whether we're going to see a rebound or not. Apparently, we saw something of a rebound in ADP, but not huge.
Mike, a lot of economists have done the work already. The kind of rebound we could expect on Friday, how much of that would come from hurricane disruption? How much of that would come from strikes ending? Are we looking for a number around 100K, Mike? Could it be that higher? Just a snapback for those two reasons alone.
Well, we could get around 100,000 in terms of a snapback. The estimate, as you were mentioning, about 200,000. That'll fluctuate this week as these additional details come in. But we had about 30,000 people who were out on strike. They'll be added back in. And the real question is, how many people were out of work the weeks that we saw the hurricane effects in the South, and how many of them have been able to go back to work? That's going to be the real question. And then on top of that, you want to add in what are we seeing in terms of new job creation? The Fed would probably be more interested in that than in the overall number.
Mike, I'm looking right now at the revisions for the prior month for the ADP employment change, and it's about a 50,000 job difference in terms of a decrease from what was reported of 233,000. And I have to wonder, with revisions like this, 50 to 60,000 on a monthly basis, does the surprise have to be really extraordinary, north of 100,000, to really make a difference for some of the macroeconomic calls coming out of the U.S. central bank?
Well, it might be. We generally don't see such big revisions in the non-farm payrolls month to month, but because of the fact that so many companies couldn't report due to the hurricanes, there is probably going to be an element of that in these numbers coming out on Friday that we also see in this ADP revised down number, that companies who couldn't report or couldn't get an accurate count for the month of October now are able to report, and we see the revision coming in. Again, the Fed is less concerned with the overall job creation number if it's more or less in line with what we have seen in the trend. They're going to look at the unemployment rate, which is forecast not to be changed at 4.1, but that is not going to be affected, hasn't been affected by the strikes or the hurricanes.
Michael McKee, thanks for the update, sir. Appreciate it. The ADP report dropping just moments ago. 146, the number, against an estimate of 150. Looking ahead to payrolls Friday, the estimate in our survey around 220. Let's get you some morning calls with equity futures higher by about 1/3 of 1%. Your first call is from HSBC, upgrading Merck to buy, noting its current valuation leaves significant margin safety in the stock. That stock is up by 0.4%. Your second call from Morgan Stanley, raising its price target on Salesforce to 405, highlighting excitement around thousands of deals in the pipeline. That stock is up by more than 12%. And finally, Wells Fargo raising its price target on BlackRock to 1,200, citing long-term opportunity following its HPS deal. That stock is up another 0.2%. Let's turn to retail. Soft consumer demand this holiday season weighing on Foot Locker. The retailer slashing its full-year sales guidance and profit guidance. Joining us now, Janine Stichter of BTIG. Janine, welcome to the program. What has gone wrong at Foot Locker?
I think they're actually doing a lot of the right things. This becomes a situation where when you're a retailer that's selling third-party brands, you're only in control of your own destiny to an extent. And we know their biggest brand is Nike. It's less important than it used to be, but it's still 60% of sales. And Nike's been very weak. So I think they're doing all of the right things to differentiate the customer experience, to bring in new brands. But they're fighting an uphill battle when Nike is as weak as it's been. And that's what you're seeing in the gross margin. They've had to promote Nike a lot to get it out the door. And that's where we're seeing numbers fall below where we thought they'd be at this time this year.
And that's why Nike's down in the pre-market as well by roughly 2%. Janine, a follow-up then. What is going wrong at Nike? What are they not making that consumers want that Foot Locker would like to sell?
Yeah, I think it's really two-pronged. I mean, overall, the issue has been a lack of innovation, where for a long time they were really focused on the channel and moving into direct and moving away from wholesale. And they almost kind of forgot about product. And then within that, it's really two categories. Running, where we've seen disruptor brands like On and Hoka make a lot of traction, and Nike's really lost a lot of resonance with that core everyday runner. And then it's on the lifestyle side, and that's what Foot Locker does a lot of. And that's the Air Force Ones, the Dunks, the Jordans, the product that people are wearing for every day to be out in the street and look cool. That product, they haven't come out with anything really new and exciting. And right now what we're seeing is the market is oversaturated with that product, which if you were out on Black Friday, you saw they were taking 30-40% off those key styles that you would have never seen them discount years ago. In fact, years ago, you would see them selling at a premium on resale sites. So it's really been a changing of the tides where they just don't have that cool product, which is what Foot Locker needs to get the customer in the door.
So basically, Janine, that we can ignore this idea that the consumer is just weaker or not shopping as much. They're just not shopping there because it doesn't seem cool. Is that right?
I think that there's definitely some element of consumer cautiousness, but right now it's just that they don't have the in-demand product because there's not a product that's working for Nike the way that we've seen in years past. I will say that 50% of Foot Locker's consumer is lower income. That definitely is a headwind. And I'll also add that stepping back, comps were up, gross margins were up, so it wasn't actually a terrible result. I think it was more just that there was optimism built into the back half of this year that you would really start to see a lot of these initiatives coalesce and really get the momentum going. Things like loyalty, better product assortments, store remodels, and all those things are helping, but you still are fighting against the tide of a weak Nike, which really makes it difficult. Last thing I'll point to is we're seeing a big change in the way consumers shop and the cadence of how consumers shop. So we saw a strong back to school season and then a big lull. Now we're seeing a strong Black Friday. We probably will get that lull again going into holidays. So that's made it harder for companies to forecast their businesses, especially when you have one like Foot Locker where consumers are really shopping around those peaks. And then in the lulls, they're just not shopping very much at all. And I think that was a big part of the miss here relative to expectations.
On a broader level, Janine, are we seeing the sort of direct-to-consumer idea fade, or are we seeing that gain traction? As there is a sort of tension that built between the likes of Nike and Foot Locker as they played around with how much they really wanted these distribution channels?
Yeah, I think we're definitely seeing the pendulum swing back in the direction of wholesale versus DTC. If you were to think back a few years ago, it was all about DTC. It's higher margin, you have control of your presentation, you control the customer's data. It seemed like that was the be all and end all. I think what companies, particularly Nike is really the poster child of this, what they realized was that they need distribution in other places than Nike.com. Not everyone wants to shop Nike.com. You need Foot Locker to reach a different consumer, and we're seeing them more willing to work with their wholesale partners than we've seen in the past. Nike's the biggest example, but we're seeing that across the industry as well.
Do you feel like they're just putting more money into these items that people don't want? I know Nike and Foot Locker are also having developed a new basketball section called Home Court. They're going to be rolling out in hundreds of these stores in 2026. Is that basically a waste of money at this point?
We actually think basketball has been a bright spot for Nike and for Foot Locker. And if we think of what the Foot Locker of the future looks like, I think that's where they need to invest. Foot Locker is known for basketball. It's what they do best. It's a core competency. So rather than try to be everything to everyone, which is really hard when you're fighting up against companies like Dick's who are putting a lot of investment behind their footwear, do what you do best, invest in basketball. It's what people know you for, and make it a unique in-store experience. Because at the end of the day, when you're selling product that's essentially 80% sold to other places, most of what you have is not exclusive. You need to differentiate on the customer experience, the selection within the categories you're known for. And for Foot Locker, they're synonymous with basketball. So I actually think that's a good investment for them. It's just not going to pay off immediately. And it's kind of table stakes. This is what they have to do. And we don't know exactly how much that will be able to drive a sales recovery for them.
So do you think it's more things like these almost like experiences you can have in the store that Foot Locker should be leaning into? You started this segment earlier saying that they're really in charge of their own destiny. Is that going to be part of the journey?
I think that's a big part of it. If you think of what makes someone shop at Foot Locker versus going to Dick's or going to Nike.com or On.com, it's the selection that they can curate, but they can't control product. They can control curation. It's the experience in the stores, which is investing in these remodels and home court experiences. And then there's loyalty, which is another big area that they've been investing behind. They relaunched their loyalty program earlier this year. It's something Mary Dillon had a lot of success with at Ulta in driving loyalty higher and getting that consumer coming back. So these are all the things they can do. I think the challenge is that there's a lot they can't do in terms of dictating what Nike does, in terms of dictating consumer health. But they're taking what they can do and putting forth those initiatives.
Janine, appreciate your time. As always, thank you. Janine Stichter there of BTIG with Foot Locker getting absolutely hammered in the pre-market, down by close to 20% now. Ugly. The NBA TV ratings are down, suffering. Shaq says it's because everyone thinks they're Steph Curry. And apparently Steph Curry ruined it. So everyone's just sitting there trying to shoot 3 points that they can't shoot.
Oh, is that so? Is that what he's saying?
Apparently.
Well, I'm not sure. I'm not a basketball expert, and if you actually tried to plumb the depths of my knowledge of either women's or men's basketball, you might be left somewhat disappointed. But I will say that there is a real question of how you keep cool at a time when there is real dispersion around the channels of cool and how they're sort of deployed with influencers.
I remember when Foot Locker used to have NBA players go to the store, sign autographs. There would be lines outside of Foot Lockers, and you just don't see that now.
It's not as cool as it used to be. Can we all agree on that? It's really not.
It's, well, I mean, the 90s, come on.
Yeah, that's like peak cool.
I mean, come on.
It doesn't get any cooler than that.
You had the Knicks, they were amazing.
Let's go back to that.
Yeah, I mean, that was amazing.
They should do a 1990s, like, revival kind of thing.
They will. Wait 5 years.
That's what they should do. Up next on the programme, Ian Shepherdson of Pantheon Macroeconomics, Ian Lyngen of BMO on this bond market, with yields a little bit higher going into payrolls Friday. So we're 60 minutes away from the opening bell. Futures still elevated, still at all-time highs on the S&P 500. We had the ADP report out just moments ago. 146, a really small downside surprise. The number we were looking for, the median estimate in our survey was 150. Some downward revisions as well to the previous month. But all being said, this labour market's looking for a big bounce back on Friday. The estimate we've got in our survey for non-farm payrolls, around 220. Equity futures then elevated up by 0.7 on the Nasdaq 100 with some morning movers. Let's cross back over to Manus Cranny. Hey, Manus.
Jonathan, good morning. Elevated is a very prescient word. Look at the force in Salesforce. This is your classic CRM. We know that. We understand that. But it is their AI product that has a good pipeline. It's called Agent Force. Bit of a difference here. Bloomberg Intelligence say, look, the monetization of the AI product is going to take a few more quarters. Piper Sandler are in there strong and hard. $405, up from $395. A robust multi-cloud adoption. So the revenue and the margins at 33% are strong. Snapshot of Merck. We can debate the political issues for Big Pharma next year, but right now, HSBC popped this up to a buy. It's buy from a hold. They see 28% on the upside, and they say the valuation leaves room to grow. Mary Barra, CEO over at GM. We know her well. Pragmatic CEO. She's looking at her China business. The stock was lower. She is going to take a $5 billion hit on the China joint venture between restructuring and the valuation of the equity investment. I like what you said earlier, Jonathan, which was China has its national champions. If not in tech, it is certainly doing that in autos. And this is a moment of reflection. And Mary Barra encapsulates this perfectly. She says domestic brands don't seem to prioritize profitability. They definitely prioritize production. So this is about where can I get better bang for my return on equity from Mary Barra. One snapshot, I'll leave you with this. JP Morgan. This is day 6 on the back foot. I can't see any other flow in this apart from we're down over 2% in the 5 cash trading days. This is day 6 of the downside. It's not some kind of sword of Damocles on JP Morgan, but it is interesting when you go under the hood of what's moving the big bank.
Particularly when that's such a consensus overweight, Manus, going into 2025. The financials, the banks, the likes of JP Morgan. Manus, thanks for that. Mary Barra is one of the best. I love that line. That's absolutely brilliant. They don't seem to care about profitability over in China.
Basically highlighting how they're overproducing in order to flood the world with cheap goods. And they want to support auto manufacturers that just keep cranking out electric vehicles to really solidify their dominance. At a certain point, how much is them throwing the towel in at a time when really foreign companies have a disadvantage?
General Motors, a name to watch this morning. Fed Chair Jay Powell, another name to watch this afternoon, speaking at 1:40 Eastern Time today ahead of Friday's payrolls report. Ian Shepherdson of Pantheon, writing low net hiring throughout October, suggests payroll growth slowed primarily due to underlying weakness. We continue to look for a fairly muted 250 rebound in November payrolls, consistent with a 125 trend. Ian joins us now for more. Ian, good morning. Good to see you in person. Now, the obvious follow-up here is hurricane, strike.
Yep.
Let's clean all of this up. What's the underlying story and how do you get a clean read on it?
Yeah, well, it's very hard to get a clean read on it, but we do know we got hard data from Florida, so we can strip out the the hurricane effect. We know how many people were on strike at Boeing, and we can guess how many other people were kind of roughly affected by it as well. So, we get a reasonable idea of the trend. The catch, of course, is that the first estimate of October, from which we're all trying to estimate the trend, will be revised. And it might be revised enormously because the response rate in October was extremely low, way lower than normal for the month. So everyone is trying to do these very precise estimates based on a number which could just be obliterated on Friday morning. So I think the trend, X all the chaos, is probably around 100 private, 125 headline. So if you're doing roughly 0 in October, you need to do 250 in November just to put you back on the trend. And I think given the incredible uncertainty that we have right now, any more precise forecasting is just, kind of a waste of everyone's time. So I'm very curious to know what the number's going to be, but I'm just as curious to see what they do to October and also to September. Back in the October report, we got a big revision to August. So, we all think these numbers are precise, but they're really not. They're a first stab. And you need to see the second and the third stabs before you've got any real idea.
Alicia has said this repeatedly over the last few months, that the number one number you've been interested in has been the revisions and not the headline print itself. And I think we're going to play the same game all over again. Federal Reserve has got to play the game. And ultimately, they've got to take their first stab and they've got to guess where policy should be. There seems to be a bias to reduce interest rates by 25 basis points this month. There seems to be a belief that they're still a long way away from neutral. Do you believe with both of those?
Yeah, I buy that. I think they will ease by 25. I think they'll skip January and wait and see what the new administration does. But I don't really have any argument with the idea that rates are still meaningfully above neutral. Small businesses, who are half the workforce works for small businesses, they're paying 9.5% for their money, short-term money, if they can get it at all. Credit conditions are pretty tight for these businesses. We all tend to focus, in markets, we're focusing on the large corporate sector, the quoted companies, the S&P. But you've got to peel back and see where most people work, which is not for S&P companies, it's for small businesses across the whole country. And those guys are relying on banks. Banks aren't lending very much, and when they are, they're charging 9.5%. So the Fed needs to get a move on to support that huge mass of small companies, which markets tend to forget about. But that's why payroll growth is now trending, private payroll growth trending at about 100, whereas at the start of the year it was trending at 200. We don't want that trend to keep going down to 0. Now, I'm hopeful that won't happen, but I think the Fed is cognizant of the risk.
I love this. This is the story of the Ians. We have Ian Shepherdson on right now. We're going to have Ian Lyngen on later, who actually has sort of an opposite read on some of the same data that you're looking at. And this has been sort of the story where somebody could take a look at data and paint it in two completely different ways while giving a fair shake intellectually to it. I'm thinking about the jolts that we got out yesterday. Some people could take a look at this job openings number and say it's actually better than expected. It actually showed an increase in the number of quits for the first time in 17 months. All of this points to actually job growth, acceleration, positivity. You shed a bunch of cold water and you say, stop it.
Deep breath. Those JOLTS numbers get revised a lot. It wouldn't surprise me at all if that number gets revised down. What actually happens is that the JOLTS job opening number just kind of oscillates around the trend, and the trend is captured much better by the Indeed job postings numbers, and they are just falling. So honestly, initial print for JOLTS, I really don't care. Quits rate gets revised as well. We put far too much faith in these numbers, the month-to-month movements in which are, in many cases, almost random, and the initial estimates are really random. We got to step back and look at the bigger picture.
But is it random that they're all surprising to the upside? And I think that that's the reason why people look at the economic surprise index. There is a clear trend, and that is that people are underestimating consistently where the economic data comes in. So doesn't that give you some confidence?
On the consumer side, that's been the story this year for sure, though I was very interested at the Foot Locker story you just ran a few minutes ago. That was astonishingly terrible. So, it's a mixed picture for sure. The consumer is surprised to the upside, business capex is surprised to the downside. And remember, the very last payroll number that we had for October was a big downside surprise. Private payroll is down by 28K, plus or minus 100,000 at least. So, there's no unambiguous story to tell about this economy right now. There are various strands about which you can be reasonably confident. Business capex is not doing brilliantly well, partly because the small business sector is so constrained. Manufacturing has probably bottomed out. We've seen a bit of a pickup in global demand for manufacturing, so that's welcome, but it's small. Payroll growth has definitely slowed. Is it still slowing? I'm not sure. And maybe I'll have a better idea after we get the November payrolls and the revisions to the other data. But I'm not seeing any pickup in the leading stuff, like the Indeed job postings, NFIB hiring, small business hiring. That tends to lead payrolls by 3 or 4 months. It's stabilized, but it's weak. and it isn't getting any better. And the consumer, that's really been driving spending, driving GDP growth. They've been relying on drawing down their pandemic savings, which are pretty much gone now. And they've also had a couple of years of very strong income growth, and that's fading away as well. So, last year income growth 4% after tax in real terms. This year, 1 to 2. Next year, kind of the same. So the momentum is not really there. It's not terrible. The Fed doesn't need to be slashing rates in a panic, but the momentum has definitely faded.
So leaving Foot Locker aside, is this the last hurrah for the consumer? Do you see the consumer slowing down actually next year in 2025?
I do. I just don't see the sort of growth in retail sales and services consumption that we've seen this year continuing, because the cash flow just isn't there. Most of the time people spend what they've got in terms of cash flow. Over the last couple of years, they've been spending, drawing down some of those pandemic handouts and savings. But that's pretty much gone for most households now. Maybe at the very top, there's still some remaining. And of course, strong stock prices have boosted household wealth for the richest people, but for the median household, cash flow growth has certainly slowed, and retailers, I think, have seen a little bit of this coming. Just looking at some of their pricing behaviour over the last couple of months, that seems to me indicative that they're seeing a bit less traffic in the stores, a bit less traffic on their websites, and they're maybe just thinking that we've actually had the best of it. I don't think the holidays will be terrible for retailers, but I don't think it's going to be a blowout holiday season.
Why is this the real deal? After seeing so many head fakes and getting this so wrong over the last few years, why is this time the real deal? What's changed?
Yeah, well, payroll growth is the really big thing. Just, over the last 6 to 9 months, there's been an unambiguous slowdown in payroll growth. And we can argue about the individual numbers. And,
sure.
When Fed officials start quoting individual payroll numbers, I just want to put my head on the desk. But they do it all the time. What they should be recognizing is that the trend has slowed substantially. And you can measure the trend in many different ways as you like. But the fact is that it's now of the order of 100K a month. And this time last year, or even early part of this year, it was of the order of 200K a month, which is not terrible, but it's enough to nudge the unemployment rate up a little bit, make people a bit nervous about future job prospects. We know that it's taking people longer to find jobs if they do get laid off, and we know that wage growth has slowed, which is ultimately what matters.
We're looking for 218 on Friday. I'm just looking at the table of the estimates, and you are near the top, which is unexpected, but you've explained why. You're looking for 250. Do you want to talk about some mid-table mediocrity just to wrap things up?
Oh, did you have to go there?
You knew I was going there.
I knew
if you don't know where I'm going there, big Newcastle United fan, mid-table mediocrity. What's going wrong?
You've just nailed it, sadly. It's tragic. We beat Arsenal, lose to West Ham.
It looked so good under Eddie Howe for a while. Champions League football.
Yeah, it's all, well, a couple of big nasty injuries and also some increasing concerns about a lack of tactical flexibility, shall we say.
OK, so you're now thinking of a Jose Mourinho come back to the Premier League?
No, anything but that.
It's good to see you, Ian. Thank you, sir. Thank you. Some of the best fans on the planet, Newcastle United fans. Ian Shepherdson there of Pantheon Macroeconomics. Bloomberg Economics looking for 182,000 jobs to be added on Friday, coming in below the median in our survey of 218. We're pleased to catch up with Anna Wong of Bloomberg Economics for more. Anna, welcome to the programme. Walk us through the underlying weakness that Ian's identified and whether you share a similar view.
Yes, so we identified that the underlying weakness is in leisure and hospitality for the month of November. Now, in October, the weakness that's unrelated to hurricanes or the strike at Boeing was with professional and business services. So these two are rather cyclical sectors, but it's kind of hard to see. I think a lot of people miss these signs because one would have thought that leisure and hospitality would be affected by weather. But what we are seeing is a pervasive, geographically pervasive weakness in leisure and hospitality. And this is the reason why we are not as optimistic as Ian in thinking that it will rebound all the way to 250.
And what's more important, the actual headline number, the revisions, the unemployment rate, or the wage gain?
I think that for markets, definitely the printed non-farm payroll. So it's quite important to know what this Friday's number would be. But in terms of thinking about the real momentum of the labor market, it would be adjusted for revision. So, Powell had mentioned that he pays attention to the QCEW report, and he does this mental adjustment to the printed payrolls. Well, the latest QCEW, which we got a couple of weeks ago to no fanfare in the market, is that the average downward revision per month in non-farm payroll should be about 100,000 from July of last year to June of this year. So if you think that everything should be revised down by 100,000 and we are getting 182,000, 80,000 this month, then the real job creation was only really 82,000, which is well below the pace needed to stabilize unemployment. And for that reason, we expect unemployment rate to climb. Which is why you're looking for 182. On Friday. Anna, thank you. Anna Wong of Bloomberg Economics looking for 182,000 on Friday. The immediate estimate in our survey, 218. I'm pleased you brought up the jobs report because quits were up, layoffs were down. I know it's the month of October, but it does speak to strength after a conversation lasting about 13 minutes, dominated by weakness.
I mean, look, people feel confident enough to quit, and you actually saw that go up, the rate of people who feel confident enough to quit for the first time going back 17 months. That should be a positive feeling, and yet we just learned why it's all downhill from here and why we're all underestimating some of the potential risks to growth.
Economists are often downbeat, aren't they?
I relate.
Aren't they? The Federal Reserve is feeling confident enough to reduce interest rates, perhaps based on the communications so far. BMO's Ian Lyngen with this to say. The incoming Fed rhetoric has been consistent in the messaging that while rate cut decisions are being made on a meeting-by-meeting basis, there is appetite among committee members for another move this month. Ian joins us now for more. Ian, good morning. Good to see you.
Good morning. Thanks
You've
for having me
identified this, and I want to go straight to it. Let's not bury the lead. Why is the 2-year at 4.20? Fed's coming out and saying we're all confident we're above neutral. We've got a long way to go. They want to reduce interest rates. Yet we've got this 2-year yield that is just stubbornly above 4%, just sort of stuck there at 4.20. What's that about?
I think that the market at the moment is still trading the results of the election. They're more worried about inflation or a surge of reflation. They're more worried about what happens when there's a renewed trade war. They're not listening to the Fed. They're not worried about the Fed cutting in December, then going again in Q1 and Q2. In a typical environment, one would expect effective Fed funds, which on December 18th will be 4.33, to function as a ceiling for nominal rates when the Fed is cutting. Right now, we could very easily find that uninverted sooner rather than later, which I think would create an interesting dynamic for the market for sure.
So who's right? Is the Fed right or is the market right?
At this moment, I think that the Fed is correct in continuing to normalize rates because they're normalizing rates not because the economy is slowing, not because the jobs market has turned over, but because they believe they have won the war on inflation. And I think that's a nuance that we as a market often overlook. Normalization is not easing, it's just cutting back to neutral.
At the same time, and this really does go to the point that I think the sort of battle of the Ians, I'm going to call that all morning, really goes to where you can take a look at something like the JOLTS report and say it's either really solid and shows ongoing strength, or you could say that the overall trend is downward. What's the right signal at a time when you hear companies that are talking about reinvesting in their businesses, hiring, after the election uncertainty has been resolved, really leaning into the whole idea of American exceptionalism?
Well, I'm very sympathetic to Ian's argument that we are overdue for a spike in the unemployment rate. The trend has been lower, but the reality is the data continues to show a resilient labor market as a theme. We have an unemployment rate at 4.1%. That's very low by historic standards. The concern, and I think this is shared among a lot of the Ians that I know, is that there's going to be an eventual spike in the unemployment rate that then gets the consumer on the wrong foot.
When it comes to the jobs report on Friday, what number would give the Fed a reason to say we're going to stay on pause?
We need to see a very significant headline print or a 3 handle on the unemployment rate. You give me a 350 headline payrolls and a drop in the unemployment rate, then the question becomes, and it's a legitimate question, is neutral in fact higher? Have we not been as restrictive as 550 might have been in prior cycles? I really think it ultimately comes down to whether or not we see a unexpectedly higher CPI number, not payrolls. Because, again, to the point, they're cutting because they believe they've won the war on inflation, not because they're worried about jobs.
Right. So when you look at 2025, and you alluded to this idea that the market is taking the cues from the political economy, the policies that might come out of Washington, what does that mean for the Fed come January?
Well, there are only so many things that Trump can do when he immediately takes office without Congress. So I think that the Fed pauses in January to see what those things are. So they take that median off, they reassess the situation, they see the trajectory of growth, they see if the type of tariffs that are announced are the type that they would characterize as a tax on the consumer or would really trigger reflation. I suspect it will be more of a tax on the consumer, a one-off increase in CPI, and then we just move forward.
Ian, do you think that people are underestimating the chance of a slowdown, a material slowdown in the U.S. economy, as everyone talks about incredible profitability and this incredible boom in the stock market and beyond?
I would say that at this moment, people are underestimating the chance that we have a slowdown. What I'm the most concerned about is historically, the Fed has been very successful at taking the edges off of the cycle on the upside and the cycle on the downside. This is what central banks are designed to do. And that has resulted in all the major corrections occurring as in the form of a crisis. So where are the imbalances? Record high stock prices speaks to this idea that there's a lot of optimism out there and a lot of optimism that's overlooking the potential downside. So a little bit nervous in terms of valuations in the equity space as well as generally in risk assets.
Try and set policy for that, the two-way risk into 2025, both to the upside and to the downside.
Yeah, well, I have to say I'm not a little happy that I don't have to do it. So good luck to all of the people on the committee.
Good luck to Chairman Powell,
exactly,
who speaks later on this afternoon. Ian, thank you. It's good to see you. Thank you, sir. Ian Lyngen there of BMO with an update on stories elsewhere this morning. With your Bloomberg brief, let's cross over to Danny Berger for more. Hey, Danny.
Hey, John. President-elect Donald Trump's pick to lead the DEA has withdrawn his name from consideration. Chad Chronister, the sheriff of Florida's Hillsborough County, said that there was unfinished work left in his current role. Chronister had faced backlash from conservatives due to enforcing lockdowns during the pandemic. GM will incur more than $5 billion in charges and write-downs tied to its China business. The car maker expects to write down the value of its JV operations and will take a hit from costs to close factories and restructure its operations in the country. This after years of declines in China and the automaker and its Chinese partner, SAIC Motor Corp. The worst performing airline this year is Tunisia Air, according to Air Help, which ranks based on complaints, arrivals, and departure times and customer feedback. Brussels Airlines taking the top spot for best all around, bumping Qatar Airways to number 2. 2 North American airlines made it to the bottom 50, JetBlue and Air Canada. That's your Bloomberg brief. John.
Danny, thank you. Exclusive around the table. Someone who's flown Tunisia Air.
Yeah, it was lovely. Into Tunis.
Oh, so you don't think it's the worst?
No, I don't.
Okay.
That was fine. The food was good, too.
Good food.
But
good
it was
travel,
a while ago.
direct.
Maybe things have changed.
It's running on time. It's win-win.
Oh, boy.
American and JetBlue not doing so well. I can speak to that.
You
but
can?
I'll speak to that another time.
Really?
Sure.
Okay.
A little bit later, in a commercial break, where I won't get in trouble. I'm next on a programme, setting you up for the day ahead. You're watching Bloomberg TV. Give you a snapshot of some of the price action going into the opening bell in about 36 minutes' time. Equities are higher by 1/3%. Bond yields are higher too. Small downside surprise on ATB. Some negative revisions, but still bond yields up by 5 basis points to about 430. At let's call it 428. As we count you down to that opening bell, your trading diary, your calendar for the week ahead looks like this. We get some remarks from Fed Chair Jay Powell at 1:30 Eastern Time, followed by the Beige Book at 2 p.m. tomorrow. We'll get the trade balance data, plus another round of jobless claims too. And on Friday, UMich consumer sentiment data and the main event, November payrolls. A sneak peek of next week, Wednesday CPI, Thursday PPI, and an ECB rate decision as well. 25 or 50. Seems to be the debate. Just before we go, just a final word around the table. Anne-Marie, I know you've got some reporting regarding the Trump transition and who's in and who's out.
Well, when it comes to defense pick, this idea that Governor DeSantis could get the nod, could be the next defense secretary, actually has legs. And I'm told he was almost basically given the job yesterday. We potentially will hear more about this either today or tomorrow, but Pete Hegseth, it looks like a lot of hurdles still stand in the way for him to get confirmed.
My takeaway is that there is so much euphoria in markets around everything going perfectly. There's a real question here about whether we're underpricing a slowdown, and the Ians really laid that out, and I thought that was interesting.
Is that the takeaway from this programme? The wrap up from the Ians. Coming up tomorrow, we'll catch up with Max Kettner of HSBC, Nuria Rabini of Rabini Macro Associates, Kathy Jones of Charles Schwab, David Leibovitz of JP Morgan, an Ian-free programme. As we head to the commercial break and wrap up this show, we're going to head over to Bloomberg's Michael McKee, sitting down with the St. Louis Fed President Alberto Mussolem at the GIC Central Bankers Symposium. Let's take a listen.
Something that would fall into the category of soft landing or Goldilocks.
You know, I try to stay away from labels like Goldilocks or soft landing. You know, I think of it very clinically, and I think, you know, we have a dual mandate, and we have to hit that dual mandate. I don't try to put labels around it. I know folks in the press love to put labels on it, and that's fine. You know, I think as I said when I began the remarks, you know, achieving the dual mandate is within sight. You know, if you look at headline PC inflation, it's 0.3 above target, which is within the margin of error, within the standard deviation. If you look at the labor market, you know, the unemployment rate is at 4.1%. That's below a level, a natural rate. So.